name is Scott Phillips. I'm the partner in charge of our national insurance office at Eide Bailly, and Kristen O'Connor is presenting with me as senior manager in national insurance office. With the exciting topic of leases. I think of leases as, I just had this thought pop in my head. Years ago, I was watching this episode of Seinfeld, and maybe there are people that watch Seinfeld and not, I'm not sure, on the line, but there was a part where he was on an airplane, and all of a sudden the airplane started to shake, and all the lights came on and said, "Put your seatbelts back on. We're in turbulence." And Seinfeld said, "Are they going to go over the instructions again? All the safety instructions again?" And I think that's what Lease is. We've been talking about it it came out in 2016, and we've been talking about it ever since. It's been a big part of A&A updates, and but now all of a sudden it's getting real and implementation. And there's been the public companies implemented a couple of years ago, and so we have that to go off of. And in addition to that, there have been a handful of private companies that we worked at that have adopted also, but now it's getting real. So hopefully this presentation is helpful to you. Like Amy said, we'll try to go through as many questions as we can, and usually we're able to keep up with those, but we'll get to you individually if we don't get to a particular question, or sometimes a question can be pretty specific. We need to look into it, but we'll get through as many questions as we can and keep up with that. So the outline today is this. We're doing a little bit differently, and if anyone participated in our A&A update that we did back in May, this is a similar, almost identical slide deck, other than we added to it. But we're taking a little bit different approach from other presentations we've done, other than the May presentation. We've gone through basic accounting in previous webinars. We've gone through implementation, sort of practical steps to implementation. What we're really doing here is going through case studies. We'll lay out the standard and the pieces. Now that people are getting to the point where they understand sort of the basic overview that yes, leases are going to go onto the balance sheet. And so we're going to go sort of beyond that a little bit and get into some specific case studies to better illustrate where these different pieces go. Let's break it down to the pieces and then talk about where the pieces go. I'm going to take this first section, identifying lease contracts, and then lease terms and payments. And actually, that section's probably about a third of the slide deck. And so the next hour to an hour and a half, I'll talk about those. Then Kristen's going to talk about discount rates, classification, transition, accounting considerations, and then modifications and remeasurements. When do we remeasure these leases? And then Kristen's also going to cover lessor accounting, and then I'm going to jump in and cover some other considerations, and then I'll finish it out with disclosures. So with that, when is this effective again? It's effective this year. Like I said, it's already been effective for the public companies. Just generally, up until a couple of years ago, sort of around the time COVID hit, FASB was already considered this, but there's always been a delay, a 1-year delay between the effective date for public companies and private companies. And when I say public companies, that actually scopes in not-for-profits that are debt obligors, bond obligors, I should say, because the bond obligor typically puts them in a classification of having a publicly traded debt security. So that triggers them to the earlier effective dates. But normally there was a 1-year delay, so there was a chance for private companies to see what the public companies were doing. And the FASB actually was talking about, maybe as a standard practice, we should have a 2-year delay because, and part of that came out with revenue recognition followed by lease accounting, which are probably two of the largest standard changes to hit, in the last, probably 10 to 20 years. And they were back to back on the heels of each other. And so actually in response to that, the FASB actually put a 1-year delay. And then when COVID hit, they put another year delay, but it had already been but public companies were already adopting. And so they got minor benefits out of that depending on when they were issuing. But it is effective. And a lot of people are like, oh, when's that next deferral coming? And I'll say this right now, FASB said it's not coming. FASB said that it's not coming. FASB has had a number of petitions to delay another year, and they said, no, people have plenty of time. Publics have been a couple of years in, and so we're moving forward. It's time to move forward with this. Now, they are still evaluating some pieces, and we'll talk about that along the way for private companies. But at the end of the day, if your hope is to wait until November, December to see if there's a deferral before you start working on it, I'd say start working on it now. So we've identified a 5-step approach that I really created to sort of break this down and go, okay, how do I really, what's my first step to practically implement, the lease standard? And our outline follows this same part, but then we tack on several different areas that we're going to cover. But step one, let's actually identify all the lease contracts. Let's gather all the lease contracts. That's the first thing we need to do. And then the next step is, okay, once we have all the contracts, okay, let's look at those contracts and let's define, identify all the pieces as it relates to the period and the term, all the pieces related to the different payments that'll be involved with it. So let's identify all those. And once we have that information, then we can start, then the next step is, okay, what discount rate are we going to use? And what's the appropriate discount rate? Because there is some guidelines and some specific considerations to how that discount rate is determined. And at that point, then we can start doing math. Then we can start doing calculations and figure out what our right to use asset is going to be, what our lease liability is. Then we have all the pieces. Then once we have that calculation, we'll run it through a classification consideration. Is this an operating lease still, or is it a financing lease? The FASB did retain the concept of a capital lease, but they rephrased that as the form of a financing lease, or the terminology of financing lease. Much of that criteria is the same. They've added some criteria to it, and Kristen, like I said, she'll cover that. And then we go ahead and book some entries. And there are some transition considerations in this first year, and so we'll go through those. So let's get right into it. Identifying a lease contract. That may sound simple, but actually I've had a number of conversations, including one earlier this week, that we concluded actually we don't have a lease. But a lease is a contract in which we have the right to use an identified asset. And that's key, that we have a right to use an identified asset. If you look at sort of the bottom right part of this, or left part, where the supplier does not have substantive substitution rights. We'll go through a few examples of what that means, but it is a distinct asset that we have the right to use, and we get all the sort of the benefit and use of that asset. A substitution right would be that the supplier could decide what piece of equipment they want to give us. And that's not the same as, say you have a copier lease and one of the copiers goes bad, so they come in and they replace it. That's still a continuous lease. The supplier didn't have a substantive substitution right, meaning they didn't have a right to just interchange it anytime they wanted. It was based on, it being faulty and needing, maintenance beyond what they could do there while you needed to use that asset, so they replaced it. That would still be a right to control an identified asset, even if there was a substitution in that circumstance. But we'll go through a couple examples, but like I said earlier this week, had a conversation with somebody where there was a tower that was placed on a building, and the tower belonged to this, call it lessee, but so they had their own equipment that they put on top of a roof, and they were leasing that roof, but that roof's primary purpose wasn't to hold up that tower. It was to provide coverage for that building. And as we got into it, we determined it actually didn't meet the definition of lease because there wasn't a specified asset. They didn't have the right to use the roof any way they wanted. They didn't have the benefit of that roof. The roof wasn't designed for that. So they didn't really control an asset other than they were allowed to use that space for their own asset. So again, you get into these and it can get kind of interesting into whether or not we really have an asset in some instances. So understanding what that is the first piece. And actually, I'm going to come back to this for a second. What's also interesting is we go to gather these lease contracts. A lot of companies are realizing that while they have controls over disbursements going out and dual signature or some sort of electronic means, they're finding that maybe they don't have as much control over the contracts. They've got departments, divisions, shift supervisors, local geography, supervisors that, and so gathering these contracts is a big part of that, of this process. So, as I talk about this, like I mentioned, what what is a lease? Once we have a bunch of contracts and we've gathered all the contracts, well, what is a lease? And I gave the example a minute ago what a lease wasn't. In the standard, there's actually a lot of illustrations of different components of the lease standard. And even if you didn't have time to sort of read that lease standard word for word, if you went back to those illustrations, they actually give a lot of color to how you apply this in a given contract. And this example that I have on the slide here, there's actually two examples back to back, one when you have a lease and one when you don't. And I'll just sort of talk about both of them. And I summarized this, and again, this is straight out of the standard. I summarized it here, but an example they give is there's a customer and they need, freight, and so they enter into a contract for the use of 10 railroad cars. And in one example, they say, the customer takes custody of those railroad cars. The railroad cars, when they're idle, they sit on the customer's property. The customer uses them whenever they need them. The customer can use them for storage while they're in an idle period. And in that case, it meets the definition of a lease. I think in this example here, there's also one where the example is, and so that's the definition of lease contract. But then there's another example where they contrast that and say, they specify that for a 5-year period, they're going to use 10 railroad cars, and the supplier in this case has a pool of railroad cars. And so the customer just lets them know when they need them and where they need them, and the supplier provides them. In the meantime, they sit on the suppliers. When they're not in use, they're sitting in the suppliers, facilities or, on their land. And so at that point, in the case of this example that's on this slide, it's the second example in the illustrations, in the standard, but it's saying that, well, back to that substitution right that we talked about, that supplier can give them any number of railroad cars. The supplier has, potentially hundreds of railroad cars that they enter into contract for the use of. And it might be any given car. Maybe there's a refrigerated car, maybe there's not a refrigerated car, but they just use whatever the customer needs at any point in time. But they sort of maintain a pool, and the customer doesn't know specifically which railroad car they're going to get at any point in time. And in that case, they're more in a service arrangement where they're borrowing or they're leasing it, but they're renting it, or they're using that car for a particular, period of time, but it's not a specific car, it's not a specific asset. And so even though they have, call it this 5-year period and this 10 railroad cars, they have sort of this usage minimum that they've agreed to in the contract, it actually doesn't meet the definition of an asset or a lease, because the lessor, or in this case, the supplier, can actually substitute any car at any given point in time. And so again, the nuance of, I have custody of that asset, I direct the use of it, I can use it during its downtime, its idle time, whether I choose to or not, it belongs to me, or at least I can direct that usage during that contract, versus at some point I just let the supplier know when they have some cars available for me as I indicate, with some sort of minimum usage requirement. So again, what is, once we gather these leases, what is it, do we really have a contract for a lease or not? A lot of times, and out of the corner of my eye, I see polling questions, so I'm just making you aware, time to wake up, take a look at that polling question. So let's talk about embedded leases. Lease Query, which is a service provider, and we actually have contracted them with Ed Bailey to use them to help determine, sort of lease information management. But they did a survey. They've written a number of articles, but they've done a survey. And in a survey, and I don't know who all they polled, but in their survey, 58% of the individuals they surveyed had identified leases embedded within a service contract or some other contract. And so, examples could be that we have advertising. We have advertising, and there's a general advertising campaign with an advertising company, but that company also includes billboards that are specifically designed for advertising, an entity's, product and whatnot. And so you have this advertising expense, but you also have specific billboard usage, which that can meet the definition of a lease. Maybe you have data storage, And in that data storage, you just have, it could be that it's not a lease because we just contracted with somebody to maintain our data in the cloud. And it could be that within that contract, we also have specifically designated 6 servers specific to our organization, and they are dedicated to us. And so there could be within that data storage, it could be just general, or it could be that there's an embedded lease because you do have specific equipment identified. Service contracts, we see a lot of this like in not-for-profit other spaces where there are, and for-profit spaces where there are, say a food service entity that comes in and they manage the food service, and there could be specific, specific pieces of equipment that are included in that. So while primarily this is a service contract to manage the food service of a given entity, cafeteria of a large, commercial building to, like I said, it could be, higher education or wherever that place happens to be. It may be that it's primarily a service contract first, but then embedded within that are specific pieces of equipment that are dedicated to a particular entity, and it's right to use and control that entity and derive all the benefit from it. So with the purchase of it could be I haven't seen much of this in practice, but there are illustrations out there that, a manufacturer enters in with one of its customers where there's a specific piece of equipment, and the customer gets the right to direct the use of that equipment, including any sort of, not only when it's in production, but also idle times. That manufacturer, while it manufactures whatever the widgets are that customer needs, and that customer needed a specialized piece of equipment that the manufacturer maintains, it could be that that piece of equipment is really directed by the customer, specific to that customer. That customer retains the right of benefit of it even during the idle times. So there are those situations also where there could be an embedded lease and some other sort of contract. So something that definitely you need to be aware of and be looking for. Like I said, in this lease query, when they're doing this, they said 58% of the individuals or the entities that were polled had identified some sort of embedded lease. So high percentage. Again, I don't know who that was directed at specifically, but certainly an awareness campaign to be looking for those embedded leases as you're gathering contracts. So once we've gathered all these contracts, now how do we know that we even have them all? Like I mentioned earlier, is where we're working with a number of organizations that realize that their contract management authorization control system really is pretty decentralized. You might have the HR manager who's in charge of contracts for their department. Accounting's doing certain things. There's different geographical locations in which local department heads or supervisors are able to enter into contracts. And so how do we know that we got them all? Well, there's a couple of ways to get at that. But as you're gathering these contracts also, those first few bullets, make sure you're getting any amendments to those contracts. We've run into a number where the contract was created 20, 30 years ago, and it's just sort of continuing either directly written through amendments, and maybe it's implicit. But any amendments, gather all those. And a couple ways to get at that. The first one is to reconcile your rent and lease expense. Reconcile that to your contract listing. So gather all your contracts, reconcile your rent and lease expense, and depending on how many contracts you have and how many leases you have, that may be sufficient. That might get you there. But some other things that we've been working with various clients on are go through your purchase ledgers or your expense accounts and look for recurring vendor payments. And in those recurring vendor payments, maybe you need to put some sort of tolerance on there. Recurring vendor payments within 5%. That's often a rule of thumb that we use, is giving a little bit of tolerance to some variability in that payment, but looking for those, trying to identify those recurring vendor payments, and then determine whether or not those are service contracts, are they, potentially lease contracts. And so that's another way that you can get at making sure that you have a complete population. Having complete population is critical. Without the complete population, all the other steps are only as good as their accuracy or the completeness of the population. So make sure you take some time to look through that. And again, you might be in a situation where you only have a handful of contracts and it's easy to identify them. You might be in a situation where there's just a lot of, large organization, decentralized, lots of departments, and geographies and locations in which different people are entering into contracts. And so maybe you need to take a closer look at those recurring vendor payments as a potential opportunity. So once you have all these contracts, then sort of the next step for these contracts before we get into breaking out all the pieces for the lease terms and the lease payments are, okay, what are the assets? And what are the assets that we're leasing? Is it land, easement, building? What is it that we're leasing? And often there are multiple components, and sometimes those components can be lumped together. Yep, we're leasing real estate that includes land, and we have the right to use the land, and we've got a yard next to it that we have equipment in addition to the building that we use for operational use. And maybe those get put together, and maybe actually that land is such that it has unique features, or that easement is such that those are really considered separate contracts. Maybe within that building they said, yep, here's a building, but also we have a bunch of equipment in the building, and that equipment is a separate component of that contract where there's a different asset that needs to be identified. So what exactly are we leasing? And to the extent that that contract includes multiple leases or multiple assets, what are those assets? And maybe they can be grouped together, like a land and building, or like all the equipment, or a number of vehicles. We've seen some where they've pooled the number of vehicles, but maybe they're separate. Maybe they've got distinct features and considerations, or we need to split those out, and they're going to result in different, calculations and tracking. Then sort of the last piece here is, I put this down as lease components, non-lease components, and not components. And I distinguish that for a couple of reasons that'll come more into play as we get later into the presentation. But the lease components are specifically, the asset that we are controlling. The non-lease components are a payment. It's included in the payments, but it's not specifically related to that asset. So for example, you lease a vehicle, and the vehicle comes with a maintenance arrangement in which they're going to change the oil every 3 months or whatever, something like that. Or it's a building, and the building actually comes with a service arrangement where they're going to clean the building, they'll clean and dump the garbages, and they're going to do maintenance on the outside, mow the lawns and whatever else. So that, and you're making one payment, but it actually has the service arrangement built into that payment. So there's the lease, which is the right of use asset, and then there's a service component or some sort of maintenance. So that's the non-lease component. And then the not components is the way I frame that up. It's not the asset, and it's not something that supports that asset. It's not associated with that asset. And which primarily is taxes and insurance. So maybe you need to pay taxes on that, or you need to pay the insurance, which those are not connected to the asset, and those should be separately expensed as they are incurred. So then we get so we've identified all the contracts, we figured out where all the contracts are at, we have identified those, maybe even implement some controls over contract management. Then the next step is the lease term. Okay, how long is this for? So the lease term is the non-cancelable period that a lessee has the right to use the asset. And then we're going to add to it any options, any renewal options that the lessee is reasonably certain to exercise. And I'll talk about that in a couple of slides. Less any termination options that the lessee has that they're reasonably certain to exercise. And then if the lessor can control any extensions or terminations where the lessee doesn't have the right to, if the lessor is in control of those, we're going to assume that the lessor is going to enforce those extensions. So again, start with our initial non-cancelable period, plus any of our renewal options that we think we're going to extend, less any termination if we think we can terminate early, if there's termination clauses, and then anything that the lessor can control, we'll include those. So how do we determine whether or not we think it's reasonably certain to exercise either a renewal or a termination? Well, there's economic incentives, there's a change in circumstance, so we're going to go through this in the next couple of slides. Okay, how do I make that determination? Should I assume that I'm going to renew? How would I know? So let's get into maybe some of these decision points. So first off, reasonably certain is defined as 75 to 80% certain. Obviously, this is, a judgment call, and 75 to 80%, adding some sort of, definition to that when it's a judgment call can be challenging. But in any case, you can see that you're reasonably, it's, you're 80% certain. So there's obviously you're not 100%, or you may not have to get to 100% certainty, but you're pretty sure that you're gonna, unless there's some extenuating circumstance, you're pretty sure that you're going to renew this or terminate it. Well, let's give a little bit of color to what that might look like, as you're taking into that consideration, taking a look at what are your future needs. It could be that we think we're going to terminate this because, I've seen a situation where somebody wanted to get into a particular area of the town. They wanted to get into the warehouse district, or they wanted to get into the downtown area. And the only lease they could find was, say, a 10-year lease, and so they went ahead and they got into the 10-year lease. And after 7 years, there's a termination clause. And they go, we don't think this facility is going to continue to meet our need, but we wanted to get into this area, this geography, this location, this downtown area, this warehouse district. And we couldn't get into a 7-year lease or a 6-year lease or a 5-year with 1-year renewals. We were sort of locked into 10 years or nothing. And so we got to the 10-year, but there is a termination, even if it's a cost. We'll talk about the cost and the payment later. But even if we think, well, we were locked into 7 years, but after that, we're going to outgrow this facility. And so we think it's reasonably certain that we're going to cancel this after 7 years. Then the period of 7 years, even though the lease term is 10. It could be that you got into it and it's a 5-year lease with a 5-year renewal, and you've put a couple of $1 million into leasehold improvements. And when you look at those improvements, you wouldn't have put $2 million into it if you didn't think you're going to get a 10-year use out of that facility. The return on investment would have been too high. And so that leasehold improvement actually is an indicator that you're going to renew it. So you're reasonably certain because of that economic factor. Maybe the termination cost, you could get out of it after 7 years, but there's just the penalty's too high and it's just probably not going to justify it. So you're just going to make do for the 10 years. Business interruptions is a consideration. When we're moving, there's always a business interruption, but if we're moving after, maybe again, it's that 5-year period with a 5-year renewal, we think, yeah, after 10 years, we may change locations after. But to get here 5 years, we're definitely committed for the 10-year, because 5 years is just not going to be, it's going to be too challenging to our organization to do that. Now, there is a practical expedient here too, in which you can exclude short-term leases. Those short-term leases are less than 12 months, and that less than 12 months includes any renewal considerations. So if it's a 1-year lease with one renewal option and you think it's really reasonably certain you're going to renew it, then it's 2 years. That doesn't qualify for this practical expedient exclusion. The reason that this exclusion came about, it came a lot from the construction industry, but there's a variety of reasons why it came about. But mostly, you're doing a project and you need a piece of equipment for 3 months. Call it a crane for 3 months, a backhoe for 3 months, or a backhoe for 9 months, to do this project. And so based on some petitioning, some feedback, the FASB said, okay, we'll allow those short-term leases to be excluded if you choose to. That's a practical expedient. It's an option. It's an election you can make. It's not required. So far, what we've looked at in the public companies, as well as some of the private companies, I think nearly 100% have elected that exclusion because it is a simplification. But anyway, just want to make sure that in this, we realize that if it's a crane that's 9 months with 6-month renewal option, so it extends over a year, and we think it's reasonably certain we're not going to be finished with this project in 12 months, so we're going to renew it, then that crane gets included. So again, you still look at that, it's 12 months excluding any sort of renewals. So this next slide reiterates sort of the same thing, but again, taking a look at, just sort of re-emphasizing again that when you're trying to consider what that lease range is, or that lease term, and look at that 75 to 80%, it's more than just, okay, pulling out the crystal ball and trying to forecast what your needs are going to be at the end of the lease term and whether or not you're going to renew it. But again, you have, contract-based factors. Again, is it going to cost us a lot to get in or out of, Is the business interruption going to be too costly? Is the termination cost going to be too costly? Asset-based consideration. This meets our needs, and so we don't see why this would continue to die. In fact, we have sort of unique and specific needs, and so this asset is customized or unique enough that, or is in a geography such that we're definitely trying to stay in this area, and so it's going to meet it. Market-based factors, again, looking at those leasehold improvements, those are, significant costs to get in or out of that lease, and then just entity-based factors. Does this continue to meet our operational needs? So again, a lot of different things, and I've said it twice, but it just sort of bears some repeating, to realizing that you don't just have to pull out the crystal ball and forecast what does this look like in, what does this look like in 10 years when that renewal comes up, or 15 years that renewal comes up. There are some economic considerations that would indicate that you're going to get in or out of that particular, location, or continue to use that asset. All right, I see a polling question out of the corner of my eye, so just waking everybody back up for that. All right, so we talked about this already, so I won't reiterate it too much, but again, those short-term leases can be excluded, but that's an election that needs to be made, and then that can be made by underlying class of assets. So maybe exclude it for equipment, but you include it for, but you're going to include leases for real estate. I'm not sure. Most of the time, people are just, like I said, what we've seen is people have elected that option globally throughout class of assets, but that is there if you have a unique circumstance in which the way you approach leases, it makes sense to have short-term leases on there for a given class of asset. That's an option. So we're going to go through some case studies for the next couple of slides before we get into the payments. When does this lease actually start? So in the standard, it uses the term commencement date, but I want to make sure that we're clear on what commencement date means. Because in the contracts, often in a contract, there's a commencement date, and that commencement date is considered to be the date that you either start making payments or that you are able to start utilizing that asset. So that's typically what it means in the contract. In the case of the standard, they use the term commencement date. I would probably use the term possession date. When do we actually take possession and start controlling the use of this asset? And that doesn't mean that you're actually deriving its operational functionality yet, but it's in your possession. You can direct the use of it. You're making improvements to it. And so when do we actually take possession? And that's when the lease starts, is when we take possession. One thing I want to clarify in here that's very important, common question that comes up is, hey, I entered into a lease contract. Let's say, just for example, you're at 12/31 year end. And let's say on December 10th, you enter into a lease contract for which you will take possession and control that asset starting on February 1st. So you entered in and you signed the contract today, but it doesn't take possession. You don't take possession until February, which is after year end. Do we record something or not? You don't record anything until you actually take control of the asset. So maybe there's a disclosure, but that accounting doesn't start until you take possession, which is on that February 1st date. So a common question that comes up, and that's why this commencement date becomes very critical, because it has a significant impact on the accounting when you're talking about particularly around year end. So let's go through some case studies that I created just to give you some illustrations. So in this first one, and actually all three are similar, but we start out with, the commencement date, I'll use that term loosely, per the contract is January 1st. So I'm going to say that's the start date that it's made of, start date of that contract per the contract. And it's for real estate for 60 months. And they actually allow the lessee, they say, you know what, you can start moving in December. So starting in December, you start moving in, you're moving your equipment, whatever you're doing to get it ready to use. Well, what's the commencement date, or what is the possession date for the standard? Well, according to the standard, the possession date would be December 1st. It's when you started to control that. So even though your operations are not up and running and functional, they basically allowed you to start using that facility or start taking control of that facility and getting it ready on December 1st. So you have 60 months of payments that start on January 1st. Well, you would actually record that on December 1st, and it would be over a 61-month period. because you actually got 61 months of control of that asset. They allowed you to start moving in and utilizing it 30 days earlier. Now, there's going to be some judgment calls in here, and I get that on exactly when you took possession. But again, we'll go through a couple more slides. And in these couple more slides, they take this same fact pattern and twist it a little bit so that you have some context. So in this next one, again, same start. We have 60 months, starts on January 1st. And the contract, actually, the lessor says, okay, you're going to start making payments on January 1st, or this contract begins on January 1st. But the lessor has committed that they're going to prepare the facility for you. And so it takes them 2 months. And so you actually don't take possession or don't take control of that asset until March 1st. So the lessor, even though the contract said January 1st and you started making payments on January 1st, really you didn't have control of that asset until March 1st. And so in that instance, the amortization period would be 58 months and you record it when you take control of the asset. So again, even though you had a contract that said January 1st, the lessor did not make that available to you for use until 2 months into that contract. So we got the same fact patterns, same 60 months. It's January 1st, but in this case, they say, okay, and this is a little unique the way I wrote this, but basically what they're saying is the lessor says, tell you what, you can get in and you can make your own improvements. And we're going to start the 60-month, the 60-month period will start whenever you're ready to start using the operations. So if it takes you 2 or 3 months, that's fine. We'll start the lease, whenever you start operations up. So starting on January 1st, the lessee starts making these improvements, and then they're done with the improvements by March 1st. And by March 1st, the facility is operational for its intended purpose by the lessee. And so then on that March 1st date, that's when payments commence, and they're required to be in there for 60 months thereafter. Well, in that case, the amortization period would actually be 62 months because they took control of it on January 1st. And then on March 1st, that's when the 60-month period started. But they knew it was going to take them about 60 days to do it. And so they actually took control starting on January 1st. This is similar to our first fact pattern where it was 60 months starting on January 1st, but they allowed them to start moving in and make these modifications on December 1st. Sort of the same fact pattern there where they took control on December 1st in that example. They took control on January 1st in this example. And so it's actually a 62-month period. So just want to make that clear that it's when you take possession. So, and the judgment really comes in, and we've seen a number of examples where the lessee requires certain modifications, leasehold improvements, and the lessor agrees to participate in those. And so it could be that the lessor is making certain improvements and the lessee does not have access to that facility or that piece of equipment. And then at some point, they start to overlap where the lessee then can take control of it. So let's say it takes 3 months, it's 3 months out, and the lessor is working on improvements, 3 months out before it becomes operational to its intended purpose. And for 2 months, the lessor is making different improvements that they've agreed to, and the lessee does not have control of that facility. And then in the last month, the lessee is doing some stuff, the lessor is finishing up what they're doing, but the lessee starts to make they start moving in and they start making their modifications. Well, in that case, it's a 3-month period for the first 2 months. And again, this is not on the slide, just sort of rambling here a little bit, but that lessor didn't make it available to them. And then all of a sudden the lessee, at some point transition, the lessee was participating in some control or directed use or benefit of that asset by participating in those leasehold improvements. And so it may not be clear that there's this distinct cutoff like I have laid out in these examples. And in those instances, that's where judgment's going to be needed to determine at what point did the lessee really start being involved enough that they were directing sort of that construction or whatever they were doing, that they really took control of that. It also might be challenging to figure out if the lessor agrees to participate, but the lessee is the one directing the construction, overseeing it for those improvements. That would be more along the lines of the lessee taking control, even though the lessors can either pay for those or contribute in some fashion. If the lessee is directing that, the lessee is taking control of that asset. So it may be a little a little more challenging to figure out exactly when they're taking control in some of those situations, particularly in real estate or customized equipment where both are participating. So with that, we'll move into lease payments. So we've identified, again, we found all of our contracts. We've identified which assets in our contracts, including all the amendments. We've identified what the assets are and broken them into the various categories. We've figured out what the lease term is, including all the extensions and terminations and renewals. Now let's figure out, before we can do the math, we've got to figure out how much does this actually cost us. So these next couple of slides, these are just pieces of information. I'll get later in the slides, I'll say exactly, okay, what goes into the lease liability and what goes into the right of use asset. Okay. Right now, what we're trying to do is just identify all the payments. So here's, these next two slides are a list of potential payments that may be applicable. And again, these first two slides are gathering information, then we'll say where they go. So fixed payments. These are the payments that, it's $1,000 a month over the next, 60 months or 36 months. Those are the fixed payments. In substance fixed payments. I have some slides and we'll talk about that more specifically because that will play into the lease liability. So getting ahead of myself a little bit, but in substance fixed payments. And again, we'll talk about that with some illustrations. Variable payments. So escalations that are based on an index or a rate, and also usage or performance. So you're going to pay so much, it could be on the copiers, you're going to pay so much for the copiers, plus you're going to pay so much for every copy over 10,000 copies. Or you're going to pay, for the vehicle, and it's going to, it's X amount a month plus X amount for every mile over 12,000 miles per year. Or machine hours on a given machine. So those are variable payments that we need to gather. These again, getting ahead of myself a little bit, don't play necessarily into the lease liability calculation, but they are required to be separately tracked and disclosed. Then we have, and there is a variable payment that is included in the lease liability. We'll go through an example of that. And then residual value guarantees. Again, I don't see a lot of these, but typically if I do, it's like say for an equipment or for a vehicle where, hey, you're gonna return the vehicle after 3 years and you guarantee that it's going to have a certain value to it. And often what happens is, you use the vehicle for 3 years, they allow 12,000 miles a year, so 36,000 miles. And so as long as you keep up with the maintenance and you return it, that's fine. But if you go, you know what, we think we're going to use this thing for 15,000 miles a year. And so when we return it, it's going to have 45,000 miles on it instead of 36. And so we're going to end up paying a residual guarantee because we used more of that benefit or more of that asset than the contract allowed without some sort of additional payment or compensation. And again, purchase options. Is there a purchase option? And we'll talk about, are we reasonably certain to renew or to exercise that purchase option? Is there a termination option, and are there costs to those? And again, we'll talk about reasonable certainty of exercising that, but to the extent there's reasonably certain, then those become part of that cost consideration. Are there incentives? Is the lessor going to give us some cash incentive? They're going to give us free rent period. First 6 months is no rent while you're ramping up in operations, or we'll give you $50,000 towards, leasehold improvements. Does the lessor going to make the improvements in which the lessee will own those improvements? So we're going to put in a bunch of shelving and the lessee gets to own that shelving. Is the lessor saying, hey, I know you've got, a year left on your old lease. I'll pay that off if you come over now, and we'll enter into a 10-year lease prospectively. And it's, there's an incentive based on this opportunity that the lessor will pay off that old lease. So those are part of those payments. Are there any deposits, refundable and non-refundable? Are there any prepayments? Initial direct costs. Are there any incentive payments for commissions? You had a finder's fee that you paid somebody. And there are, again, we talked about penalties on the previous slide as well, but are there any penalties that we think we're going to incur? So purchase options, penalties. So Termination penalties is usually what's associated with, but so again, this is an information gathering. We'll talk about what we do with all these in a minute. So we've gathered all these different payment components. What do we do next? Again, we have our lease components, our non-lease components, and our NADA components. And we talked about those in previous slides, so I won't push or reiterate it too much, but giving a little bit of flavor again to this. You know, the lease components is the right to use the asset, the non-lease components, if we have not adopted the practical consideration and the practical expedient to include those non-lease components. I can't remember if we talked about that or not, but we'll get to that. But there is a practical consideration where you can include the non-lease components. And then there are the not components, meaning if we're paying a lease payment plus we have to pay for taxes and insurance, those would be expense. They would not be part of this. Well, we need to identify those, but then we would expense those. But we need to identify all those different pieces. So here's the practical expedient that I was getting ahead of myself on. If we want, in this previous slide, you can include the lease and the non-lease components together. Often they are not split out, and you can determine that by class of asset. So you can say, well, for our equipment, we're going to include it all, but for our real estate, we're going to separate it out. So you can determine by class of asset if you want to include the non-lease components. It was interesting, the Center for Plain English Accounting, which is sort of a subgroup within the AICPA, they recently did a survey and they produced a report just in the last week. And they looked at a number of public companies, and they didn't give the scope of what that was, but they were surprised at the results, which was about 75% of the public companies have adopted the practical expedient to include the lease and non-lease components. Often those non-lease components, that maintenance piece, so you got that vehicle, in that vehicle that you've got that oil change that's embedded in there. Often it's not separated out. And so it can take a lot of work to say, okay, what is the value of the non-lease component if it's not explicit in the contract? And so it was interesting to hear that 75% of those public companies have included the non-lease component. Now that will have some impact later on. It does make your lease liability larger. Also, when you're determining, and not to steal Kristen's thunder to some degree, but when you're determining, you know, whether or not you're in a financing lease versus an operating lease, that can have an impact on, you know, one of those criteria that you're evaluating. But it is, again, it's often not separated. And so it becomes challenging to determine what the value of that is. What is the fair value of the non-lease components? So again, most companies, it sounds like, are adopting that, but just want to make you aware there is an option to include that. You know, estimating what the residual value guarantee, are we going to use this beyond what was allowed, and are we going to have to pay some additional amount at the end? Determining the estimate, that becomes a challenging piece because that's an estimate. It's not just as clear in the contract. And then determining with reasonable certainty, you know, are we going to exercise a purchase option or a termination clause? What are the costs of those? So that's a decision point that needs to be made. So that's an estimating. And then again, if you're going to combine leases or separate them out, you have different, you know, if you have land or easements including the building, do you want to include those together, or are we going to separate those? You know, and then allocating prices. You know, before we talked about determining whether or not you're going to have different, you know, assets that you control. Now we're talking about how do you allocate the price point to those. So these are the decision points that need to be made. These are the places where there needs to be some estimation involved, where it's not, may not be just as clear as in the contract, here's the amount. All right, so what goes into the lease, you know, our lease liability? And we're going to go through a few examples of these, but our fixed payments, including the in-substance fixed payments, less any lease incentives. And again, I'll go through some illustrations of this, but so our fixed payments, including in-substance fixed payments. Also, we include variable lease payments that depend on an index or rate. And I'll go through an example of this because this is not just an escalation consideration. This is how we calculate what our lease payment was going to be on day one consideration. And then if we think it's reasonably certain, again, that 75 to 80% threshold, that we're going to exercise a purchase option, we'd include that in the price. And then if we think, again, in the illustration I gave before, where it's a 10-year lease, we wanted to get into that lease because we wanted to be in the warehouse district, but we think after 7 years, it's not going to meet our needs, and we're going to exercise that termination option. If we think it's reasonably certain, that we're going to exercise the termination option, and that comes at cost. We'll include that. And then the residual value guarantee that we think is probable of being owed. And so those are the different components of that we need in order to do our lease liability calculation. What we exclude are, again, those escalations. And again, and I'll go through an example, and I see a polling question pop up out of the corner of my eye. So just a reminder that that's out there. So any escalations we would not include. And again, that, if I come back to here, and I'll go through this example in a minute, but if I come to, this sort of variable payments depending on an index, that is not the same as just an escalation. So if you have an escalation, if you have performance-based, like it's 2% in my retail space, retail clients, often there's like a 2% of gross revenue or something like that, some percentage of gross revenue. If it's, extra for machine hours or number of copies made or, number of miles, if there's some sort of performance or usage-based payments, those are not included in your lease liability. If there's any guarantees of lessor debt, and I don't see that often, but sometimes if a lessee has engaged a third party to basically be the owner of a facility that the lessee will then lease, sometimes they'll guarantee the debt of that lessor because the lessor is participating in, this, and this is a way to sort of minimize sort of long-term debt options or financing, situations. And then again, those non-components, the taxes and insurance, and again, those non-lease, if you have not adopted the practical expedient, then the maintenance piece would also be excluded. But if you've adopted the practical expedient, then it goes in. So that could go either way. So let's get into a little bit more specifics. These in-substance fixed payments, what does that mean? So there's two examples, and I got two case studies. The first example is a payment that does not create genuine variability. And so I'll go through an example of that. And then the other one is you have different payment options that have variability in them, but you're going to end up with one of those payment options. So I'll go through examples of both these because those are sort of confusing, concepts until you see an illustration. So the first one is this: you enter into a lease, the initial payments are $10,000 a month, and there's an escalation built in that's based on CPI. So an escalation based on CPI with a maximum increase of 2%. And once an escalation hits, there's never a de-escalation. So if CPI goes down, your payments never get reduced, but they always get, increased. And again, you have this cap of 2%. And if you look at the last 20 years of history, that 2% was always hit. We always had that 2%. And so in that instance, you look at it and you say, okay, the standard would say that's an in-substance fixed payment. In other words, that 2% escalation is, even though it's written with some variability to it, it's basically in substance a fixed 2% escalation or fixed 2% increase over the life of that, that lease contract. And so that instance, it lacks that economic substance. In other words, again, you're going to end up in a situation where you expect that 2% is just like, it's written as if it was just a fixed 2% over the course of time. So in that case, you would build it in. So if it was just a general, hey, it goes up and down with CPI, or it goes up and never down based on CPI, and there's no sort of minimum or maximum, then you would not include it. But if there's this maximum and history shows that you always meet the maximum, you'd build it in as an in-substance fixed payment. Then you have a case study, or in this case study, this is what I was saying before, is the lesser of two options. And so let's say you have a land and building that you're going to lease for 10 years. You're going to pay $10,000 a month plus 10% of annual sales in excess of $2 million. And at the end of the 10 years, if the sales exceeded 3 million for at least the last 5 years, the lessee has an option to purchase the property for $600,000. But if the sales are less than 3 million in any of the last 5 years, then the lessor can force that purchase. They're required to buy it. So if you look down here, you have the fixed payments. You know, they're going to pay $1.2 million, the $10,000 a month for, you know, the 10 years. And that's the same for both scenarios. But then either they're going to end up paying $500,000 in variable, or they're going to be with this purchase, they're going to be forced with this purchase option. So while there is some variability in this, they're going to end up with either paying, they're for sure going to pay either 1.7 million or 1.8 million. And so while they are written with variability in them, they know they're going to end up with one of those payment streams. And so they would take the smaller one, in this case, the 1.7 million, and they would use that as the minimum payments. The minimum, that's an in substance fixed payment, because they know they're going to pay at least that. So a little confusing, but again, hopefully this illustration helps you understand these in substance fixed payments. And then this case study is just similar to what I was saying before, which is you have I mean, this just sort of goes through a scenario, but basically what it's saying is we have escalations built in, and the escalations are, you know, escalations are not included. You know, again, we have the in substance fixed payment where, again, in this scenario, you really had basically a fixed 2% included in it. Whereas in this scenario, there's just sort of an open-ended, you know, over the course of time. Actually, I'm off one. It's this one. Over the course of time, there's just additional escalations, and you just include those as period costs in the year that you include that escalation. So I got off a little bit on this slide. This is a little bit different scenario. If I come back, I'm just going to go back. I know I'm making everybody dizzy here. In our lease payments, so we talked about these in substance fixed payments, right? Well, now I want to talk about what is this lease payment that's dependent upon an index or a rate that gets measured into our lease liability. So in that instance, that's what this example is. And what this example illustrates is, again, we have a 5-year lease, discount rate 8%, you know, and then what they did is they said, okay, your lease payment is going to be $1,000 multiplied by the CPI on an annual basis. And the CPI on day one is 125. And so your annual lease payments end up being, you know, this $125,000 a year, and it will escalate over time. But your initial payment is calculated in this calculation format. In this case, you would take that initial payment, that initial 125,000, and in that payment, you would just assume that that is your fixed payment starting out, and you wouldn't include any future escalations like we've talked about, but you would do the initial calculation and then base your present value of that based on this calculation on that initial payment. So I haven't really seen a lot of leases like this in which your first payment, instead of being a fixed $1,000 a month and we'll have future escalations, it's now we're going to take a certain amount of the index and calculate what that initial payment is. But to the extent that your lease works that way, you would calculate it. And again, you wouldn't factor in future escalations, but you would then fix that over the course of time and make that become the basis of your lease liability. And then when I get to this example, we talked about those escalations. Those just sort of open-ended escalations. It goes up and down by some market adjustment, or, you know, some undefined market adjustment or CPI index. In those instances, you would do the calculation as if it were fixed based on those initial payments. And then in year two, in this case, it went up by 2.5%. And so that extra $2,500 just becomes an initial year expense, or just that expense of that year. So they just get run through the current year. All right, so then what do we do with the right of use asset? Well, the right of use asset is calculated at the lease liability. We start with the lease liability, and then any payments that the lessor that we make to the lessor at or before commencement, we would include. So if I come back to this example, we paid $100,000 on the front side, and so that $100,000 is included in the right of use asset, but it's not included in the lease liability, because the lease liability was, we calculated the future payments which is the remaining payments, not the one we made on day one, right? And so we start off, it's this lease liability minus that initial payment or any prepaids, or we would add that to it, and then any initial direct costs minus any incentives. So it's the lease liability, including the down payment, if you will, initial direct costs, and then minus if the lessor gives us any money or any incentives, then we would subtract those for the lease liability or for the right of use asset. So we'll go through a couple of illustrations here. So examples of the lease incentive, again, we talked a little bit about this, but a lease incentive could be that they're going to give us some cash on the front end. It could be that the lessor is going to pay for certain improvements that the lessee will own, or they could exit. Again, you got 1 year left on your lease, and the lessor says, I'll pay that lease off if you can come enter into this 10-year lease with me. Those are examples. If the lessor pays for an improvement that the lessor then owns, or if the lessee pays for an improvement that the lessor owns, that's not considered a lease incentive. And so just making sure that we're clear that if the lessor pays for something the lessor owns, that's not a lease incentive. If the lessee ends up paying for an improvement that the lessor owns, that's part of the lease payments. So that is not, so just making sure that we're clear on those. All right, so let's go through an illustration. So the lessee, they're going to pay $100,000 a year for a lease. It's a 5-year term, 7% discount rate. So the lease liability in this simplistic example is, and the payments at the beginning of the term, and so the liability ends up being $410,000, and the lessor is also going to give them $25,000 to help with moving costs and improvements, whatever else. So the entry is the lease liability is $410,000. The right of use asset is $410,000 minus the $25,000 of cash they received. So we get into the next section, and we start making payments on this. And so we pay $100,000. And I want to be clear, this example has been simplified just for illustration purposes. Normally with that lease liability, you'd amortize it potentially using some sort of, maybe a different effective interest rate or something like that. But I just straight lined it for simplification. So the lease liability, it needs to come down by $82,000. The right of use asset, $385, needs to come down by $77,000. Well, what's the offset? So the offset is the lease expense, basically, and you're not necessarily amortizing that $25,000. It's just that your entry doesn't balance unless you include that component of it, which is essentially amortizing the $25,000 of cash. And so in this instance, your lease expense is actually the $100,000 minus the $5,000. So your lease expense is $25,000 or $95,000 a year over the course of that lease. So with that, we've gone through, again, sort of the big picture. We've got to identify our contracts, identified all the assets, determined what the terms were going to be, identified all the different payment components, and then we've, dovetailed that into the calculation of the lease liability and the right of use asset. So lots of information here. But with that, we'll move into the next section. I know we've got some questions here. I don't know if, Kristen, we want to go through those questions now or wait.
Yeah, we can. Whatever you think, or we can, move on and save them for the end. Whatever you'd like to kind of break it up, do some questions right now while this information's fresh in our mind.
Let's go through these, and I'll try to answer them while I'm trying to read them and answer them at the same time.
Okay.
So the first question is, does ASC 842 impact private companies that are cash basis? So the answer to that would be, if it's a cash basis, then you wouldn't have a lease liability on there. So the impact would probably be in the disclosure area. You'd probably continue with some sort of disclosure of requirement, but cash basis or modified cash basis, you would not be recording these non-cash liabilities in those instances. Sometimes in a modified cash, I'll probably talk too much here, but sometimes in a modified cash, you can bring on like long-term capital assets and liabilities that are based on cash outflow. This wouldn't qualify as that sort of liability, because a long-term liability, then in which you got the cash from a note payable to pay for whatever it pays for, is not the same as this, because this didn't result in any sort of cash outflow on the front end. And so it's not based in a cash transaction, so it would not be included. However, again, probably have some disclosure. You need to determine, we'll go through disclosures later on, but you need to determine what disclosures are relevant for the users, still considering a cash basis financial statement. The next one, what about electronic or digital billboard signage for ads showing 15 seconds at a random time? So let's talk about advertising for a minute. And I see this often, there's a billboard with a set sign on it. And that billboard on the freeway or wherever it is at for that signage, the specific purpose of that billboard is to present, advertising opportunity, and that is an asset specific for that purpose. So that would be considered a lease. Okay, I want to distinguish that first. Then when we get to the electronic one where our ad is one of a number that are flashing up, in that instance, my belief is that we don't have the right to control that asset. Now it does have advertising on it, but we're not controlling that asset like we are with a stationary billboard. So because we don't have the right to control that asset, then that would not be considered a lease, in my opinion. Now, that said, I'll also throw out, and this isn't anywhere in the guidance, but there is illustrative, white papers, and they distinguish between what I'll call two factors when it comes to that advertising. One is if it's a set billboard that's stationary, again, doesn't have all the different, advertisements rolling through it, you are directing the use of that billboard for that period of time. If you have a sign on a wall, like in the gymnasium, you go to the college or the university, and there's a sign that says XYZ Corp. And in that instance, it's on the wall. The purpose of that wall is not to provide signage. The purpose of the wall is to hold the building up. And you don't control the use of that wall. And even though you might have advertising for the space, you don't have an asset that you are specifically controlling. And so that doesn't meet the definition of a lease. So in those two sort of extreme examples, you have a definition of a lease and not a lease. So in this electronic billboard, in my opinion, it probably fits more of that. You don't really control the asset because they're flipping through lots of signage. I'm not sure what this next question is asking, so maybe somebody can ask me offline. Is the contract in perpetuity fall under GASB 87? This is more of an 842 conversation, not really a GASB 87 conversation, but a contract in perpetuity, there probably is some facts and circumstances we need to talk about. So I'm not really ready to answer that question here, but we can certainly talk offline. Are all easements considered leases? If we have a right to a perpetual right of use easement and we pay a fee at inception of that easement, but there's no further payments made, is the easement perpetual and there's no defined clear term? So easements have some separate guidance related to them. And, in those earlier slides, when I said, what's the definition of contract and what are the assets that we control? As we talk about that, land versus building versus easement would potentially need to be separated out. And we'd have to consider whether or not that easement, it may be that easement has to be separated out and separately evaluated. I'm not sure in that case where you're not paying a perpetual lease. You just paid a one-time fee up front for a continual right of use for that easement. I'm not sure. I'd need to take a look at that. Maybe we can talk again. Feel free to reach me offline and we can talk specifically about those circumstances. Our building lease has an option to renew for 10 years at the end of our current lease, but it says that lease payments will be at market rate. We will likely renew the 10 years. You have to record the renewal, even though we don't know what the lease payments will be. So in that instance, I think the answer to that question is yes. And so what you would do is you would start with, in the lease liability, you would start with your fixed payments, that we talked about. And again, there's that one variable, but basically a variable that you determine at, commencement. And then what you do is you would actually project those out over, let's say it's a 10-year and you have a 5-year renewal and you think it's reasonably certain you're going to renew it for the 5 years, but the rate resets, you would use the fixed rate over that 15-year period. And then you would just adjust for those market rates as they happen. What if there's a lease that does not have a stated end date? A related entity owns a building, and the assumption is that the lease would continue until they decide not to do it anymore. So I will get into that shortly. I'll actually answer that later on, but I do have some slides on related parties, and we'll talk a little bit about that. But that's actually a place that the FASB is currently looking into. When they wrote the standard, typically when the FASB writes the standards, they're primarily for, well, I don't know, they probably wouldn't like it if I said this, but they mostly have a public company perspective in mind. But they do have the private company council, and the private company council is not a standard setting body, but they do provide advice to the FASB. They meet directly with the FASB, provide them advice, and the FASB takes that advice into consideration, determining whether or not there should be any sort of private company considerations, whether that's a simplification or a separate standard specifically to accommodate private company considerations. This is more of a private company consideration. They don't really see this as much in the public companies. It hasn't come up. But oddly enough, I actually have a meeting where FASB or the private company council is doing some outreach, and I have a meeting next week with them that reached out to our firm, and I'm having some conversations about what about this situation. And again, I'll get a little ahead of my slides. I said I was going to answer it later, but I'll answer it now and later, probably both. But if you end up doing leasehold improvements that would indicate that you're going to lock into that, is there an unwritten or implied consideration in whether or not you have the right to use that asset through the life of that leasehold improvement? Say it's a 10-year improvement that you do, it's a 10-year useful life. Is there implied or written, unwritten consideration there where you know that you're going to lock into 10 years, or where there'd be a legally enforceable right because of the improvements you've made? Those would be the types of considerations you'd need to evaluate. But that is sort of a space they're trying to hopefully provide some definition around. And again, I'll get more into that later, but that's at least get you, in this initial answer. Is the concept of receiving the first month free? I kept talking, so I'm not sure where that came in, but I'll say, if you start making payments the first month, the first 6 months are free or something like that, but you take control of the asset, that first month free you would take into consideration in terms of the lease obligation or the lease payments, in terms of present value of those back, but you would record it when you take control of the asset. So even if there's a rent-free period, the day you take control is the day you book the liability, and that free rent would just be considered when you're figuring out what the actual payment obligations are in terms of present value and back. All right, I think I'm down to nearly the last question here. I've seen short-term lease defined as 12 months or less, and I've also seen it defined as less than 12 months, which means 1 year. Could I clarify? My definition is 12 months or less. So if it is so it's not less than 12 months, it's 12 months or less. So if it's a year or less, then that's my definition. I have to go back and see exactly how it's written in the standard, but I believe it's 12 months or less. So you can enter into a 1-year lease. So if it's a 12-month lease and there are no renewals considered in there, then it would not, and you adopted the practical expedient, it would not be included. If it's a 13-month lease or a 12.5-month lease, that's when it would. So, all right, that was like speed dating question and answer. So hopefully that was helpful as I sort of rambled through all those. But in any case, we'll turn it over to Kristen and she'll get us started. We'll go a few more minutes here, and then we'll take a break here probably in about 15 minutes or so.
Perfect. And then Scott, I think you'll have to stop sharing so I can start sharing. It's given me a little warning saying that I can't. Thank you. Okay, everybody. Well, thank you so much for spending some of your Friday with us talking about leases. I know that this has been one of those topics that I feel like we've been talking about since I was in college many a moon ago, and now it's finally happening. And so it's like, okay, wait, what do I need to care about? What pieces do I need to look into? How am I actually going to do this? All of those kinds of, thoughts are coming up for all of us. So we're going to jump into discussion about the discount rate and the options that are there on the FASB side. And then after that, we'll probably take our little break that we'll have, and then we'll come back and start talking about classification and some other fun topics. So discount rate. What are our options under FASB for, what should this rate be? What guidance is out there? So we've got 3, and it's kind of a hierarchy a little bit in here. So basically, as the lessee, if there is an implicit rate under the lease that you can determine, so there's enough information in the lease for it to be determinable, so maybe like in an equipment lease or something like that, you could kind of figure it out, you got to use that. So that's going to be required if you can determine what it is through the lease agreement. And a lot of times, if you have a building lease or certain types of leases, you're not going to be able to do that. So then what's, second piece on the hierarchy, now where do you go? So at that point, you have either the incremental borrowing rate as an option or the risk-free rate. But the risk-free rate, that's only going to be for our non-public company friends. So if you're a public company, you're going to have to go with your incremental borrowing rate and determine what that is. But if you're non-public, you have options about, what's going to make the most sense for you. So we're going to go through each of these 3, kind of, highlight some points about each of them and maybe some decision points about why you may want to go a certain direction. So the first one, the implicit, like we discussed, if you know it, you got to use it. But it's rarely stated. So that's, usually where we tend to see that happens to be in leasing arrangements with financial institutions. So, and this, you're only going to, where it talks about, well, if you can determine it, you have to use it. It should be minimal effort in order to determine it. Like, we're not going to be going like above and beyond, doing all sorts of crazy analysis to figure what this out. It needs to be, easily determinable within the rate. And then for related party leases, so the expectation is the same. There's no difference or a different requirement that you would have versus your unrelated party. So just kind of throwing that in there. But this is, the implicit rate should be, easy to determine if we're going to use it, that we have to use it. But most of the time, that's probably not going to be the case, right? So let's talk about the ones where this is likely where you're going to have to go. So incremental borrowing rate. So this is the rate of interest that the lessee would have to pay on, and these are the important components to pay attention to. So a collateralized basis over a similar term for the amount equal to the lease payments in a similar economic environment. So you're having to get as close as you possibly can, right, to what would that rate likely be that was, in the lease. So you have to get specific on these elements. We can't just take like, oh, well, this is a 5-year lease, I'm going to use my 20-year financing that we just did. That's not going to make sense. They need to be similar characteristics, right, that we're looking for. So let's go into that a little bit more on like, okay, but how am I going to do this? Like, where do I look? So if you're going to be determining this incremental borrowing rate, what could you do to get that? So, I'm starting off, I'm going to skip to the second bullet point. If you're borrowing regularly, and, this is readily available for a similar profile type, like maybe it's some kind of, leasing of a specific type of equipment, and you do that regularly. So you really already know what this would be if you were to buy versus lease and finance it. Then that's where you're going to start, as compared to, if you have any current borrowings that are of similar terms, rates from your recent loans, maybe you'll have to take into consideration, credit rating. But remember those lease specific factors that it, has to be collateralized. What would that be? And that the term should be similar. And if you, maybe this like history, you don't have something that you can go off of. You could also obtain a quote from a lender for similar terms. Like, okay, if I were to finance this purchase instead of lease, what would that well, what would I get from my local financial institution that I work with? And again, I mean, the auditor side of us, right? Document, document, document. Whichever way you go in determining what this is going to be something that your auditors are going to be testing and looking at. So you really want to make sure that you have everything documented about your thought process, the guidance that you used, all of that readily available, easy to access, so it's reperformable. You don't want to be like, oh, wait, where did this information come from? And then you're having to dig back and trying to remember. A lot of times we're asking for this stuff like a full year after you've made some of these decisions. So this is just one of those heads up, like, yes, your auditor's probably going to be asking about it if you had to determine an incremental borrowing rate. So just be prepared for that piece. Okay, and then your calculation likely is going to be unique, maybe to even each lease or class of leases. So, you could potentially have like a portfolio approach where you're constantly leasing the same type of asset. And so like vehicles, maybe you always do that in a group or something like that. So for those, when they have similar terms, you could probably use the same rate, but there will be, if you have very, different and specific types of leases with all sorts of little caveats in them, then likely you're going to be having to do this calculation for each lease separately. So just think about that when you're thinking about the time it's going to take to do this as well. Think about your lease profile and portfolio, like what do you have going on? Are they similar? Are they very different where, you're going to need to spend some time with this? And again, this is going to have to continue to be updated. Like you're not going to set this rate as of today and that's what you use forever. Every time you have a new lease, you're going to need to make sure you're using, like consistent information for that type of lease and all of the different components that it's got going on, whether it's term and all of that. So as you can see, as we're talking through this for our non-public friends, you can see why maybe an option came about from this, because this is quite, the undertaking in order to do this for each specific lease. So that's where, we do have a risk-free election option for our non-public friends. For our public friends, unfortunately, that has not been extended to you. But for my non-public friends, you can use the risk-free rate election. And so if you're a non-public entity, you can do this by class of asset. So again, like we were talking about with the incremental borrowing rate, that makes sense, right? Because the characteristics of an equipment lease may be very different than that of a building lease. So, the rate, you want to make sure you're using a rate that's consistent with the lease term and all of that. Again, like we mentioned before, implicit rate, if you can figure that out, you got to use that first. Like this doesn't get to piggyback in the hierarchy and go first. That's where you're always going to start, see if, the implicit rate can be determined. But if it can't, then not easily at least, then non-public entities can go to the risk-free rate election. So, pros and cons of this stuff, right? So the pros, simple, easy, you can go look it up, right? Go see what the treasury yield is or whatever. Cons is likely this is going to create a higher liability, and there'll be a slide later that kind of, some things to think about on, how that can affect your financial statements. So determining your discount rates, what are our decision points that we're going to have to make? So, okay, we know we got to figure out what a discount rate is, but like, what do I need to decide? So for my non-public friends, your decision is going to be, if you can't figure out the implicit rate, right? Whether or not you're going to elect the practical expedient to use the risk-free rate. So it's a practical expedient that has to be elected. So that is a decision that, once you consider these things, that you can make or not make. And remember, the risk-free rate can be done at class of asset. So if that makes sense. And then if you're not going that route, or if you're a public company, you'll have to develop your incremental borrowing rate. And remember, collateralized basis, similar terms, similar economic environment. So you really want to have as many of the characteristics of the lease taken into consideration as you can when you're developing that incremental borrowing rate. So I think one thing would be to think about, like we mentioned before, kind of look at your portfolio of leases. How many do you have? You know, are they very similar? Are they diverse? Does this make sense? You know, which of these decision options make sense for you? You know, if you're non-public, yeah, maybe if you have a bunch going on, maybe you want to go risk-free rate just to simplify some piece of this process, because there's a lot, you know, a lot going on with leases, that a lot of decisions that have to be made, a lot of documentation and things like that.
A couple questions have come up about, can you use a line of credit rate? Well, the answer, Kristen likes to say the answer to all questions are, it depends. But let me give a little bit of color to that. I mean, often when I'm looking at line of credit rates, they're usually variable. So sometimes they don't fit, but I guess you could look at what the rate is on a given day. But variable rates tend to be a little lower than fixed rates. But also line of credit, it depends on what the terms of that line of credit are, and does that line of credit actually align with the lease that's being entered into? So let me give a couple of examples of that. If you have a line of credit and the underlying collateral is the receivables and inventory, which is pretty common, that's not going to carry the same sort of collateral as, say, real estate. Real estate might have more value as a collateral base. It may end up with a lower rate if you were to borrow against inventory versus borrowing against real estate, potentially. Also, if you have like a 5-year line of credit and you enter into a 10 or a 15-year real estate lease, those terms don't align. And the longer the term, the greater the rate. So the longer the term is, the greater the rate. And so, does the collateral align? Does the time period align? So, but that doesn't mean that you can't get some value out of that rate as a starting point. I mean, often, like Chris was talking about, if you can get to, okay, what's a borrowing rate for today, and let's build onto that. So maybe we lock into a line of credit rate and say, well, the collateral's a little bit better, so that's going to lower the rate. The term's a little bit longer, that's going to increase the rate. And maybe there's some information that line of credit rate that actually gives you sort of credit risk of the entity. So the entity has its own credit risk that they can kind of build off of. So that is, so it's not that it couldn't be used, but it certainly, it's unlikely that that rate itself would align such that it would align exactly with the lease terms. So those are the things you need to consider. It's interesting because the FASB actually got some push on, the challenges about coming up with an incremental borrowing rate that aligned with the terms, the underlying collateral, and they came and asked for some simplification. And actually came back and said, well, that's what the risk-free rate is. So those are your two options. Either do the time to do some, tailor that calculation, or contact a lending institution. And maybe if you have a line of credit, you can talk to the institution and say, hey, I entered into this sort of rate. What sort of rate would you get? And see if they'll give you some sort of quote that you can keep in your documentation. At least now you've got a relationship that maybe gives you something to build off of that's a little bit easier to get that rate. Next question here is, does the rate of interest used change throughout the lease period? We're actually going to cover that. In fact, 2 questions came up along that. Do you need to change it? We're going to cover that a little bit later. We have a slide that captures that, but the answer is, initially, it's no. It's, you entered into a lease today. This is what you think your incremental borrowing rate, or use a risk-free rate today. And that's the rate you use. You lock into it, you do the calculation, the liability is set. And then any changes to, those incremental borrowing rates, they wouldn't impact your lease calculation unless you have an event that causes you to remeasure the lease. And certain events will cause you to remeasure the lease using a new rate, and certain ones would have you use the old rate. And we have a slide that gives a graph that, or a chart that depicts that. So we'll cover that later on. Next one, is there a standard source for the risk-free rate? The risk-free rate is published in a lot of different areas, and risk-free rate is a little open-ended. Often it's the treasury bills, and what you'd want to do is pick a treasury bill that has the term that aligns. If you pick the risk-free rate, what's the, what's the 2-year, if it's a 2-year lease, what's the 2-year term versus the 5-year term versus the 10-year term. So you'd want to fix the risk-free rate. Like I said, it's usually treasury bills, but sometimes people will equate, long-term governmental bonds with some of the as the risk-free rate. So there's if you look it up, you can look it up in a number of places, and usually it's fairly consistent, but those are the different rates that they base it off of. Then we're getting into something outside of rates, but just to go back and clarify. So slide 41 shows recognizing lease expense as payments are made. Should that have reduced the liability? So just to clarify, in slide 41, it was a simplified example, and the purpose of that slide was to illustrate what do you do when you have a lease, a lessor sort of incentive, and how does that play into your lease expense. So that was the purpose of that. The reality is this, and I'll just sort of lay out a broader foundation, and then we can get more specific if we need to, if you have additional questions, either throughout the presentation or if you want to follow up with us individually. But if you have a financing lease, formerly capital lease, when you record that, then the payments coming through would reduce that liability, and you'd have a component of interest expense that also relates to that as you amortize over an effective interest method. In the case of an operating lease, the expectation is that the operating lease is nearly identical to what it is today, meaning it's a straight line. It should result in a straight line expense over the course of the lease. So how that impacts the reduction of the lease liability and the right of use asset. The right of use asset should be straight lined over the course of time. The lease liability likely as well, but then those payment streams, how they flow in, you may need to balance that out. But the end result, so without getting into a variety of entry options, depending on sort of facts and circumstances and different sort of payment pieces, the end result should be that the expense is straight lined over time, just like it is today. Next question is, how do you handle capital lease under 840 that has a set rate of say 5% at transition to 842 if you elect the risk-free rate by different class? Well, what I would say is we'll get into transition, so Kristen's going to cover that. But basically, if you have a capital lease liability, if you have a capital lease, it's going to be a financing lease. Those typically don't get remeasured, they just come across. And so this is more of a prospective consideration in those instances. It's really the operating leases that are getting measured for the first time, but those capital leases would just come through. And then, can governmental entities use the risk-free rate? Again, this presentation is for 842 for FASB entities, but I think 87 does not allow that same option, doesn't have that same practical consideration option in the GASB space. So that's one that normally what happens is the FASB actually came out with the leases first. And what GASB does is they're in the same building. So all the staff, they have different staff and different charters, but they're, under the same sort of umbrella. And the GASB typically monitors what the FASB is doing, and then they challenge whether or not they should be doing the same thing. And so, but then they'll make changes based on what they think the answer should look like. And so when FASB came out with the lease standard, GASB was already sort of in the range of following, but with different nuances for governmentals. And I don't think that is a practical expedient that they thought was something they wanted to include in that standard, so they didn't include it. So, all right, I think I made it through all the questions again. So if you have questions, keep them coming. We want to make this, oh, it looks like there is more questions there. Sorry, I need to scroll. I think it's been coming in as I've been talking. As we are adopting now and capitalizing at possibly the midpoint of the term, would you use a discount rate at the current rate or when the lease would have started back at the effective date? So again, sort of transition guidance piece, but you can actually determine what the rate is today. So or I'll call it January 1st. So if you're adopting as of January 1st, 2022, this year, you wouldn't need to go back and figure out what is the rate back. And we entered in this one in 2004 and this one in 2016 and this one in 2012. You could just decide, again, with the capital leases, they're going to come across as is because they've already been discounted. But you would just determine what the rate is as of January 1st, 2022. And you could sort of determine that fairly globally. I mean, a lot of people, what they're doing is they're breaking the rate up into a couple of pieces. Hey, they might have 2 or 3 rates and they go, hey, for our short-term leases, less than 5 years, we're going to use this rate. For our 5 to 10 year, we're going to use this rate. And our 10-year plus, we're going to use this rate. And they sort of figure out what that looks like. Again, looking at length of term and class of asset, but you can determine what you think that rate is. And usually people are coming up with a couple of different rates depending on those terms, how much is left in the lease. But you can determine as of January, if you're into a 10-year lease and you're 7 years into it, as of January 1st, you can just determine what's the rate as of January 1st for a 3-year term that's left. And so that's sort of one of the simplifications to get you going. And then a lot of what we're talking about is sort of prospectively after that. There's a question about polling question, and so I'll let Amy handle that one. Does the reasonably certain standard change when the lessor is a related party? I'm going to actually defer that one, but we do have a slide specifically where we're going to talk about that. And then we pay base rent plus CAM expense for office. How should we handle the variable CAM? So again, when it comes to the maintenance piece, if you're in triple net leases or you've got the variable piece, if you're including non-lease components, it may need to be, if you choose not to have the practical expedient for non-lease components, you would expense that as incurred. If you include the non-lease components, it may be included in the lease liability. And again, taxes, insurance would be excluded. So I think let me keep scrolling. Another question popped up while I was here, but that's okay. We'd rather answer your questions and make it meaningful and for you. Consolidated financial statements, including business and real estate holdings. Supplemental of the two companies are shown. Would you still add the lease standard to the supplemental information? So, the answer is yes. So and this is actually a really good question, because if you're in a consolidated and you're only presenting the consolidated financial statements, you can present it however you want because the consolidated is the number. If you're going to present supplemental information in the back, that supplemental information should be derived from and then reconcile back to the consolidated information, but it should represent that supplemental entity. So in other words, if you had, say, 2 entities and you decide, you know what, we're just going to throw all the leases on one of them because it's easier. If you only present a consolidated, that probably is fine. But if you're going to present supplemental and have 2 different companies and they both have leases on them, well, you're representing, while typically an auditor is not going to opine on that, which I know this is about accounting, not what level the auditor is opining on, but if you're going to present that in the back and represent that it is an allocation, an accurate depiction of the activities within those individual companies, then yes, you should present it in the individual company. So if you're presenting supplemental information for the subsidiaries or, all the different entities that are included, it should be separated by those. Otherwise, you lose some meaning, and when that doesn't present fairly the activities of the individual components that you are representing and presenting, to whoever that user group is. All right, Chris, I think it's back to you. I think I've kept scrolling and I think up to the bottom. So keep the questions coming. We want to make it useful.
Exactly. And it's nice to go through them while this piece of the content is fresh in our brains, because, as we keep moving through, we go into different aspects of it, and then sometimes it's harder to remember, wait, what were we talking about on that piece? So yeah, it's been super helpful to kind of stop and pause and cover things as you all have questions. So now we're going to jump into lease classification. So we're going to focus, I'm just going to, throw this caveat out there. We're going to focus primarily on the lessee first. We will have some slides later on the lessor side of things. So there will be some slides that kind of incorporate both of them together, but we're gonna focus first on lessee, because I think that's where most are encountering leases. Okay, so like Scott's mentioned, our whole idea of the capital lease is still kind of there, but now it's called a financing lease. And this is where, so we have the elements for, you know, what would trigger a lease to be considered a financing lease. And this is where I was like, these are going to look pretty familiar to maybe some things we've seen before. There are some tweaks to the, you know, the prior guidance, but a lot of this is very similar. So if you had some like nice acronym or a little song that you would remind yourself of what all the components are, it'll be probably pretty similar, and you can just add, you know, the fifth one on. So our first one is if there's ownership transfer by the end of the lease term. So, you know, the lease is going to happen, and then at the end we get that asset, then that's going to qualify as a financing lease. If you have an option to purchase the underlying asset and the lessee is reasonably certain to exercise. So this is one that similar to what we had before, but a little bit of a different flavor because it's not talking about bargains. It's just option to purchase that the lessee is reasonably certain to exercise. That's another one of our, you know, triggers for classification. The lease term is a major part of the remaining economic life of the asset. So this is the one that if everybody remembers from before, so we had title transfer, BPO, 75 or 90. Some of you may remember that from your CPA exam studying days. But this is where the 75 is no longer like a hard and fast rule here, but it's still guidelines, right, on what would, you know, major part of remaining economic life be. So there's a little bit more probably decision making here on remaining economic life, but you can still use that 75%, and then for the next one, the 90%, that can still be kind of guidelines used, but it's not in the standard that it has to be, you know, like that's the in or out determination. So number 4, present value of the lease payments equals or exceeds substantially all of the fair value of the underlying asset. And that's where the whole substantially all, that's where that 90% has come in historically. Here's our new one. So this is the one we've got to figure out some kind of acronym, something fun to help us remember it. But if the underlying asset is specialized in nature, and it's expected to have no alternative use at the end of the lease term, then that's going to trigger this to be financing lease. So if you have a piece of equipment, you know, specially produced for you that that company can't just take that and now sell it to another company to use it, like it was made for your space or for your product, then that's going to trigger this to be financing lease. So yeah, if anybody can come up with like a really fun song or, you know, an acronym for these, like feel free to throw that in the Q&A and we will share with the group. Okay, so here's our summary. This is the one that I mentioned. It's going to talk about lessee and lessor. We'll go into the lessor side a little bit later, but sometimes it's just nice to see kind of both of them together. So of our fun 5 that we just went over on the last slide, if one criteria is met, on the lessee side, it's a finance lease, and on the lessor side, it's sales type. That's kind of like, again, like I mentioned with discount rate, there's kind of a hierarchy. Like that's where we're going first is, you know, just one criteria has to be met, and then you're going to go to there. If none are met, so we didn't meet any of those 5, for our lessee, it's operating lease. So that's how they're going to treat it. You know, that's how it's going to come on. Lessor, there's a little bit of a fun caveat. You have to take into consideration these 2 other options first to see if it could potentially be a direct financing. So present value of lease, including the residual value guarantee, and then probability that the lessor will collect all lease payments and residual value guaranteed. So as long as that's for the first one, the present value of the lease payments greater than substantially all asset fair value. If it meets one of these or both of these, then you're direct financing. If it doesn't, then you get to be operating. So kind of operating is like the last stop, you know, for your options on the lessor side. On the lessee, you just got the 2. You either meet one of those criteria or you're operating. But on the lessor side, you may need to take into consideration a little bit more before you get to that determination that it's operating. So just don't forget about that. You have to take into consideration these 2 to see if it's direct financing before you just automatically go from, nope, it's not a sales type to, oh, it's an operating. So fun stuff. Okay, some practical expedient impacts. So we talked about some of our practical expedients as we've been going through the presentation. So taking a step back, like, okay, how does this actually affect things if we do elect them? So if you decide to include your non-lease components, you know, if it's just easier, just group it all together, put it in that lease liability. You don't want to, you know, be spending the time to break it all out. It's going to increase your liability. You know, makes sense, right? Same, if you use your risk-free rate, likely going to increase your liability. And then the thing to think about, why this is important for, you know, for everybody to be thinking about now as you're making these decisions, is if you have an increased liability, that may result in a finance lease classification on your financial statements. So like those the items that we went through before, we get that liability up there, and maybe we get closer to hitting one of those out of our Fund 5. Oh, I like that. Maybe we'll go with Fund 5 for our lease classification items. So just something to think about from an, you know, as you're making these decisions about which way you're going to go, just know how that may affect things. And we'll kind of go through their slides later on, you know, debt covenants and all of those kinds of considerations, but that this may impact your decision making as you're electing these practical expedients. So let's talk about transition a little bit. We're going to point out just a couple things for everybody to be aware of. You know, throughout the last year, we've had some entities that, you know, have early adopted 842 or were required to adopt 842. So we've seen some things, we've seen, you know, some maybe recommendations on things to think about or not to forget about when it comes to the financial statement side of things. So for the leases, the transition guidance, you have options on what this is going to look like in your financials. So you can do it retrospectively to each prior reporting period. So if you have dual year financials, and you can go back to the beginning of, you know, what's being presented in those financial statements. So then you'll have your cumulative effect recognized at the beginning of the earliest period presented. So likely in your, you know, the beginning of that second year. And then you will, the application date later of the beginning of the earliest period or commencement date of the lease, and then adjust the comparative amounts disclosed for each period. So then it's like you're showing both years the same, right? Disclosures, everything is consistent when you get into the footnotes, because now everything being presented is under 842. Now let's throw in that other option. What if we did retrospective at the beginning of the period of adoption? And this is one that I think we've seen a lot on, many clients have decided to go this way. So you're running your cumulative effect adjustment through retained earnings, your application date beginning of the report period of adoption. So basically it's going through the beginning, but if you have dual years showing, guess what? You got to still do those disclosures under 840. So you have a set of disclosures under 842 for the current year information. And then you have your disclosures for the prior year under 840. So that's something where I think that sometimes we try to do, you know, clients will try to maybe do this modified retrospective approach where you're doing this beginning of the period of adoption, and then forget the 840 disclosure. So that's been one of our most common notes, you know, as we're looking at financial statements coming through with anybody doing the modified retrospectives, like, oh, don't forget. And the 840 disclosures includes like your 5-year payout schedule, which feels a little weird to be including sometimes now that we're, you know, in the next year, but just make sure that you're getting all of the information that you need to have in there if you're going to take this approach and not, you know, retrospective it back for both periods presented. So just a little tip, reminder of things. You'd rather have all of that information ready to go, you know, and not be finding out about that like as you're trying to issue your financial statements that, oh, we need to add additional disclosures or something like that. Okay. Some practical expedients. Let's kind of recap some of these. So there's a package, and we've alluded to this already for some of this information, but there's a package of expedients for existing or expired leases. So like when you're adopting those ones that have already been going, right? So they don't start the day that the lease standard is effective. They were in place from before. So before we go through this has to be elected collectively. You can't pick and choose like which pieces you like of it. You have to do kind of it all together, right? But if you elect this package of expedients, so depending on the leases that you have, this may be a direction you would want to go. You don't have to go back and determine whether or not your contracts contain leases. You don't need to go change up your lease classification between operating and capital, which is now financing. Like it can just come over as what had already been determined in a prior period. You don't need to reassess any initial direct costs. And then you can use hindsight in determining, okay, are we renewing? Are we terminating? Are we purchasing? You know, those things that, you know, when the lease first started, you didn't maybe know. Well, now as time has gone on, maybe you know that about these specific leases already in place, you can take that into consideration. So that's just, you know, if you don't want to go back in time, because I think there's enough work, you know, on a lot of these for just the new leases going forward. This is an option to elect this, you know, package of practical expedients. And then I know that we had, you know, touched on land easements really quickly before, but land easements not previously classified as leases, you don't need to reassess them. So we don't need to go back in time to determine if that land easement from a prior year is a lease. So that is something to kind of think about. Does this package of practical expedients make sense for you? You know, especially depending on the remaining term of the lease that you have in place. How much time do you want to be digging back to try to figure out all of this when you could use hindsight with the information that you know about for some of these pieces? So heads up on that. Okay, so let's talk about like, what does this look like? How does this actually like work as we're adopting, as we're transitioning to 842? What happens? You know, sometimes you just need that like 10,000 foot view of like, okay, what is this going to look like? So we're going to kind of go through just high level, you know, discussion about the measurement at transition, and then we'll go through some examples. And again, these aren't going to be all inclusive of every type of scenario that there is, but what, you know, maybe the common ones that you may come across. So operating leases, because this is the one, like Scott mentioned, things are changing for our operating leases. Our capital leases that are now financing, they're, you know, if you elect that practical expedient, especially like where you don't have to reassess everything, everything's coming over like it already was, right? We're not having to go back in time on our capital leases and change up, you know, how things are being recorded. It's really our operating leases where we're seeing this, you know, significant change on the financial statements. So first thing we're going to do is we're going to have our right of use asset and a lease liability, right? That's what you think about balance sheet. Okay, what's this going to look like now? Those are the items that are coming on our balance sheet. So for measurement of those, we're going to take our remaining minimum lease payments, any amount probable of being owed under a residual value guarantee, discount rate determined at the application date. And remember, we have our three options. Either the implicit rate, which you got to use if you can figure it out, your incremental borrowing rate, or risk-free rate for our non-public friends. So then for our right of use asset, we're going to adjust it. So we started with this lease liability and we're going to adjust it now to get to our right of use asset. So you've got to adjust for the following things. And we'll go through some of these in the next examples so you can like actually see numbers, because sometimes that helps with that visual. But you have to take into consideration, you know, any prepaid amounts or accrued lease payments. So we talked a little bit about, you know, our risk, like if you have those rent-free periods, things like that, or you prepaid, you know, rent, like just make sure you're taking into consideration if the payment stream's not matching up, make sure you're taking that into consideration and get the right of use asset adjusted for any prepaid amounts. The remaining balance of any lease incentives, you're going to adjust for any unamortized initial direct costs, and this will all make more sense as we see numbers. Also consider, do you have impairment of that right to use asset? That's going to be a constant thing to think about now, you know, from now on, is potential impairment now that we have this asset that we're recording for our operating leases. And then the carrying amount of the liability for any exit or disposal costs. So if you have any of those in there, you're going to adjust for all of that. So if you did recognize something as a capital lease under 840, basically what's going to happen is you're going to de-recognize the amount of the capital lease asset and lease obligation, and any difference recognized in the right of use asset as a prepaid or accrued rent, that difference got to go somewhere. And then you'll recognize a right of use asset and lease liability at the application date. So that's if you're choosing, you're checking like, oh, we didn't elect our practical expedient. Now we have to look, this was a capital, oh, but now it's operating under the new, standard somehow. So that's what you would kind of like the steps you would have to take in order to transition it over. Okay, so let's look at some examples, because I really feel like once you can see numbers, then this all starts making a lot more sense. Okay, so our first example, this is going to be the basis for the ones that are going to come after too. So a lot of this fact pattern is going to stay consistent. So kind of just try to remember some of these key facts. So this was what we're looking at. It's an operating lease under 842, and it was also an operating lease under 840. So operating lease under both standards. It's a 5-year lease agreement. Started, we're going to pretend this is last year, started January 1st of last year. The application date for us for the standard is the beginning of this year. So we've had a year go by, right? So we only have 4 years left on our lease. So our lease payments, years 1 and 2, and this is annual payments, so not monthly, but 1 and 2 are set at $31,000. Years 3 through 5, it goes up to $33,000, but they're set. We know what they are. So as part of this whole situation, we had some accrued rent, $1,200. We also had some unamortized initial direct cost of $400. So those are going to come into play later. Our incremental borrowing rate is 6%. And this entity has elected the package of practical expedients for not reassessing whether contracts contain a lease, the lease classification, and the initial direct cost treatment. So we're not gonna go back, even if this was supposed to be, would be now capital, like financing lease under 842. We're not doing that because remember, we're not gonna go back and reassess if we elect that package of practical expedients. We're just moving forward. So what looks like, what happens now? So our operating lease previously under 840. So what we have to do now to bring this on, because it wasn't on before, is we've got to first recognize our lease liability. So our liability, the math behind all of it with those that borrowing rate and all of that, it gets us to $112,462. So what that is the present value of the one remaining year that was at the 31,000, because remember it was years 1 and 2 at 31 and then it went up, and then the 3 years at the 33,000, discounted using our incremental borrowing rate of 6%. So that's where we start. We get to that lease liability amount of this amount. Now remember on the previous slide, we then are going to start with that, but then we have to add some adjustments to get down to our right of use asset, right? Because there can be some differences between the two. So the differences, like we talked about on the prior slide, is that we've got to de-recognize our accrued rent. So we take that lease liability amount, we're going to take that down, and then we're going to add in the $400, the initial direct costs, because we're going to de-recognize that. So that gets us to our right of use asset amount is going to be $111,662. And the difference between these two is your opening balance equity adjustment. So we talked about doing that equity adjustment at the beginning of the period. That's where it comes from. So you may have some differences here between the two, depending on the terms and all of the other things that are involved. But that's basically how that entry would work, is you're bringing on the liability, you're bringing on your right of use asset, and then that difference is going through your opening balance equity. Okay, let's switch it up a little bit. Same, remember I said it was going to be similar fact pattern throughout these, but it's operating under 842, but it was capital under 840. What happens then? So we still have our unamortized initial direct costs, $400. These are determined not to qualify as an initial direct cost under 842. So you'll need that information. Our capital lease asset, because remember this was a capital lease under 842, so we already knew this information. It was $108,673. And then our capital lease obligation was $112,462. So we know that information, what it was under 840 as a capital lease. Now what do we do with it to get it to be operating under 842? Okay, so what we're gonna do, gotta recognize our lease liability. So same amount, you know, the 112,462, calculated that same way that it was in example 1, right? We have 1 year left at 31, oops, skipped ahead. 3 payments left under the 33, 6%. Then we get to our right of use asset. How do we get there? It's a little, these are the things we have to take into consideration. Again, remember we start with the lease liability. So we're starting with that 112,462. Then the difference between the capital lease asset and liability that we had, you know, from when it was under 840, that's got to go somewhere. So that's going to be treated as prepaid or accrued rent. So that difference from that was on the previous slide is the $37.89. And then that $400, those initial direct costs that we say don't qualify under 842, we're writing those off to equity. So then we get down to this right of use asset of 108,273. So different, you know, a little bit of a different scenario, but again, you know, getting to your right of use asset, starting with that lease liability, taking into consideration some of those other components if you have them, and that's how you would get to the amount for the right of use asset. Okay, got one last example. So it's a capital lease under 840, and it's still a capital lease under 842. So before transition, this is what we had recorded. So we had a lease liability of 128, fixed asset 124. We had some unamortized initial direct costs. At the effective date, the transition adjustments, we elected our practical expedience. So this is what's going to happen. The lease liability stays the same. Our right of use asset is going to change just a little bit because those unamortized initial direct costs are going into our right of use asset. So you can see it was 124,000. Now it's the 126,000 from that 2,400 initial direct costs. Impact on equity, there's none. So just so you can kind of see like which types of changeovers are going to affect equity, which ones don't. Those transition examples kind of help just to see the numbers of like, okay, what is this going to look like? Where does the difference go? I think that's sometimes like if we're going to have a difference between our lease liability and a right of use asset, like, okay, what do I do with it? So that's where these examples kind of help show you, okay, if you had this situation, this is what happens to them. If it's this situation, this is what happens. So you have these in your slides to refer to as needed. Okay, so measurement as at transition for our finance leases, because remember our slide before was primarily focusing on the operating side. So remember again, like if our, like in this example number 3, we just went through, if it was previously a capital lease and it's, you know, staying as a finance lease under 842, so it's going to be very similar where you're going to recognize the right of use and lease liability at the carrying amount of the capital lease asset and lease liability under 840. And then you just have to shift, you know, just adjust a little bit if you have any of those other things that would be different, like any unamortized initial direct cost would be incorporated into the measurement of the right of use asset. If it was previously an operating lease under 840, how do we get it over to a finance at 842 if we don't, if you know, like didn't elect those practical expedients? So you're going to recognize your lease liability at the application date based on your remaining lease payments. You've got your right of use asset, which you start with your lease liability and adjust as needed, right? For any prepaid, accrued rent, exit, disposal costs. And then write off any initial direct costs that do not meet the definition under 842. So some examples in here to use based on your personal situation on, you know, whether or not you're electing or not electing the practical expedients. Some other things to think about. Your operating leases, we kind of talked about this a little bit earlier. The discount rates should be established as of the effective date. So the beginning of the year that you're adopting this standard, right? So we're not going back to, for the most part, to where, you know, this initial lease was entered into. We're talking the beginning of the period. What's the economic environment, the credit ratings going on at that point in time. Doesn't specify whether the rate is the total lease term or remaining lease term. Either is acceptable, but just remember to document which one, why, you know, all of the things like we talked about before. And then remember, impairment's now a thing we have to think about. So your right of use asset, if it's abandoned, impaired, you may have to consider write down after the initial measurement. So if something happens with that, then you'll need to, you know, take that into consideration. Whew, okay, so we did it. Initial year on the books. Now what happens when they change the lease agreement or something happens in a future period? What do we do? So we're going to talk through a bit on lease modifications, remeasurements, what triggers it, what do you need to think about? So the first thing to always think about, if there's a change, you want to think about, is the modification to the agreement actually a separate contract? So that'll be the first place you're going to start here. So what would trigger it to be a separate contract? So if you have additional right of use that was not included in the original lease. So an example is you were leasing 5 vehicles and now you're going to lease 7. That's an additional right of use not included in the original lease, so it's going to be a separate contract. Or the other condition that has to be met along with the additional right of use is priced at a standalone price of the additional right of use. So like your lease agreement amount is going up at a commensurate value with those new assets that are being added on, right? Like you're not paying a premium or a discount for this additional right of use. It's going up at a rate that it would if it, you know, if it was a standalone contract. So if you are meeting both of those, it's going to be a separate contract, and that's how you're going to treat it. Okay, but let's talk about some remeasurements. Like when do we go back, like we were talking about, change the interest rate or like mess with things again? Like when do we have to do that? Okay, so this is when you're going to treat something as a remeasurement. The modification is not a separate contract. So it doesn't meet those two things on that previous slide. So there's changes. So here's some of the other factors that could come into play. Changes in probable amounts due under residual value guarantees. So what you think's going to happen, something's changed there that it's significant. We need to take that into consideration. Or maybe you had variable lease payments that they were contingent on something happening, like meeting certain thresholds for production or something like that, and they turn into fixed lease payments because that contingency's been met. Those are going to be things that are going to, you know, like affect a lease remeasurement because now something has changed, something significant has changed. And then there's some events that cause lease remeasurement. So we have this asterisk that there is a triggering event. So these are the things that you'll just, you know, keep in your brain, like, oh, is that a triggering event? Did that happen? Do I need to now, you know, remeasure my leases? So a significant event or change in circumstance, and then this is the key point, that is within control of the lessee. So the lessee is the one, you know, making the decision or a different decision maybe about renewals, terminations, purchase options. It's the lessee's decision to be made, not one of those where it's like mutual agreement or the lessor decides. Within control of the lessee. That's going to affect lease remeasurement. Some event maybe that was in the contract happens that requires the lessee to exercise a renewal option or terminate the lease. So maybe there was something in there that like, oh, if this happens, you're, you know, you have to stay in this lease or you have to leave this lease. That triggering event could cause a remeasurement. And then a lessor does not elect to exercise a renewal option previously determined to be or not to be reasonably certain. So we thought we were going to renew and then, oops, something's changed in our operations or our business strategy, we're not going to anymore. That would be a triggering event for remeasurement. So what are some examples, like what could this be? What would be a triggering event? Some real life examples. So if you construct some pretty significant leasehold improvements, that could definitely have an effect on the term, especially. Like Scott had mentioned that earlier, that, you know, if you start customizing a space to yourself and you've put in things that aren't easy to take with you other places, likely you're going to stay in that place for a while, right? So by doing the construction of significant leasehold improvements, you may have almost set a term or made a determination about renewal options. So does that line up with what you had previously decided? If you significantly modify or customize the underlying asset, that could be something that triggers lease remeasurement. A business decision, maybe it's strategy, you know, direction of operations or something, where it's going to have an effect on whether or not the lessee would renew, terminate, purchase, you know, any of those kinds of things. That's going to be a remeasurement event. And then subleasing the underlying asset for a period beyond the exercise date of the option. So these are the types of things that if this happens, light bulb will go on, like, oops, okay, this is a big enough deal. I need to go back and we need to look at lease remeasurement. So here's a nice little polling question. Make sure you get that. I know we're getting to the point in the day where sometimes we need to be reminded that those are up there. So remeasurements, here's a nice little table Scott had mentioned earlier on, okay, if you have a contract modification, what's going to change? You know, you're going to remeasure your liability and your right of use asset, reassess classification, update your discount rate. Same if it's renewal, termination, or purchase options from one of those triggering events like we talked about. You're going to have to, all the things change basically, right? But if it's a change in your residual value guarantee, then it's really just remeasuring the liability and right of use asset. If it's the variable payment contingency resolution, right, where we had some kind of threshold we had to meet, we met it. So now the variable turns to fixed. It's just the liability and right of use asset. So this is just kind of nice, you know, a nice visual to be like, okay, if this happens, I've got to do all these things. If this happens, I only have to do these things. And then again, like, so maybe it goes the opposite direction. We talked a little bit about, you know, like, oh, we have new assets and that's a separate contract. But, you know, think about if it's reducing the scope of the contract. So maybe then reducing the number of assets leased or whatever, you're going to adjust your right of use asset in a proportionate manner. And then the net difference between the lease liability and the right of use asset will be recorded in earnings. So just in case things go the other way, you know, what would be taken into consideration there? Let's look at an example. Okay, so we've got a lease, we're leasing a building, 10 years, 5-year renewal option. At this point, we're not reasonably certain to exercise. Because remember, reasonably certain is like a really high threshold. So at commencement, we don't know. We don't know what we're doing, you know, 10 years from now. So, but we get to the end of year 7 and the lessee, we build some stuff, right? We tailor this building to all of the things we could ever possibly need or want. That now that useful life is probably extending beyond that 10-year lease. And now, hey, we're staying. Like we put this into it, we're not leaving now. So then you're going to reassess our lease classification based on the updated lease payments as of this point in time that this triggering event's happening. Lease payments for 8 years, because now we're like, hey, we're taking that 5-year renewal. So we had 3 years left at the 5 years, and you got to update with your discount rate. You're going to remeasure that lease liability at the end of year 7, and the difference between the lease liability and the carrying amount of the existing lease liability gets recorded to that right of use asset. So I think this is one that, you know, at the beginning of a term, sometimes it's hard to know, but business decisions happen along the way that then you, at a point in time, it becomes a different decision on like, and you have a different threshold of like, yeah, we know that we're going to renew. So this is how you would do the accounting side if that were to happen. Okay, what about if a lease, like the opposite? we're not going to remeasure it from what would that situation have to look like. So same set of circumstances, the end of year 7, the city invests in a major road infrastructure, which makes it way easier to get to our location. So now we're going to stay because of that. Well, that event wasn't anything that was in control, you know, that the lessee was in control of. That was like outside of, you know, anything that we had control over. So it's not a triggering event, doesn't meet the requirements on our fund list that we had. So we're not going to reassess the lease term. Fun stuff. Okay, so let's move on. We're going to talk a little bit about lessor just really quick. Go kind of through the classification, a couple different things there for your consideration if you happen to be the lessor in one of these agreements. So like I mentioned earlier, we got 3 options on the lessor side. So again, if you're meeting any of those, you know, requirements, then you're going to likely be in the sales type. If none of those were met, but you had those 2 other options, and we'll go back to that slide again in a minute so you can see what those 2 were, with the present value and the residual value guarantee, all of that. You could get direct financing. Doesn't meet any of those, then we get to operating. So remember, operating is kind of like the bottom of the hierarchy on what it will be. Here is a nice slide so that you have as a reference point of what does it look like for each of these different types of leases on a lessor's financial statements. So if balance sheet, what does balance sheet look like on operating versus sales type versus direct financing? So you can kind of see like, okay, this is how it's going to be treated on the balance sheet. Like I'll still have my underlying asset if it's operating, but if it's sales type, or direct financing, then it's a net investment in lease. And there's a little bit of a difference. If you have a direct financing, you have to include the deferred selling profit and any initial direct costs that qualify. What does it look like on my income statement? So, you know, operating, like we talked about, is nice because everything's straight line. But it would be a little bit different on our sales type of, you know, what's going on the income statement. So you can see the selling profit is on the income statement here versus where it was on the direct financing. If you have a loss though on the direct financing, you will recognize that on the income statement now. And then where it's more the interest income is our income statement effect. And then what does it look like on the statement of cash flows? So just a nice reference of like a visual of, okay, how does it look differently between the 3 options? And then this was that slide I had mentioned earlier. Remember, if you meet both of these 2, then you're direct financing. If you don't meet any of our Fund 5 or these 2, then you get to be operating. Okay. We're getting there, guys. We're getting to the end. So let's talk about subleases really quickly. And then I will pass it back over to Scott and he'll talk about, you know, related parties, because I know there's been lots of questions about related parties, and then also the disclosures. So subleases. Okay, I was leasing something and I'm going to lease it to somebody else. What do? I'm going to follow lessor accounting. So those slides that we just went through, the lessor accounting is what you're going to follow if you are doing a sublease. You're going to classify the sublease based on the underlying asset, not the remaining term of the original master, the head lease. You're going to do, okay, what is the underlying asset, the term for that, the useful life for that. The sublease term is longer than the remaining head lease term, then that's going to trigger remeasurement. So just a couple things to think about of that are a little bit of different caveats when it comes to subleases. So just be aware of that if you are entering into that situation, like, oh, okay, there's going to be some things to think about that could be slightly different than how I would treat this as a lessee or lessor. So just remember your classification and the term that's going to come into play. So you just need to be aware of that information. Okay, I'm going to pass it over to Scott. I will stop sharing so he can can start sharing.
Great. I'll start sharing here in a second. So just a couple quick questions and then I'll jump into the next part. So one question came up, says we signed a 20-year lease and there was a $2 million lease incentive. 80% must be spent on improving the premise with the landlord's approval. And a portion of that was actually spent on a parking lot improvement that's not part of the square footage as defined in the lease. Actually, I think that parking lot piece, I like that because it actually will help illustrate the rest of the example, which is, well, and then 20% is used at their discretion. Question is that a leasehold improvement or is that a lease incentive that gets netted against the right of use asset? And so the question that you need to answer, and actually that square footage of that parking lot improvement is a great piece of that, which is, does the lessee own the assets? If the lessee ends up owning the assets, that would be a lease incentive. If the lessor owns it, in other words, in this case, let's take the parking lot as the prime example, the lessee oversees the construction based on some lessor funding. They oversee the construction, but as they oversee that construction, they don't actually own the end result of that construction, in this case, the parking lot. So if they're overseeing the construction of the improvements, but they don't actually own those improvements, then that's not a leasehold, that's not a lease incentive, but if the lessee does own them, then that is an incentive. So that's the piece that needs to be distinguished in order to get to the sort of the end of that question. Question, could we provide some sublease examples? Yep, we can do that at a later date if somebody wants to ask some questions or reach out to us, happy to do that. Let's see. All right, a company leased a building and the lease is expiring 2024. The company subsequently moved out of the leased building into their own building. So the company then found a sublessee to finish out the remaining lease term. So in that instance, there's still an obligation, and there is a little bit of guidance about this where you need to determine what to do with it. But let me give a couple of scenarios. If the lessee who moved into their own building and is just sort of trying to find a way to, use a sublease to finish out that lease term, if the lessee is still the primary, leaseholder, and if they are obligated for that, they would continue to have that less, the lease liability on their books. And then you would follow, the accounting that Kristen just went through as a lessor for the sublease portion. If somehow you're able to actually transfer or assign those to the sublessee in which you're out and you no longer have an obligation, then you can move forward with removing that from the books. So it all depends on sort of where you end up, but it's likely in some of those cases that you'll end up still retaining that lease liability until you get to the end of that term again, unless you can sort of transfer that and the lessor is willing to take and make them the primary obligor of that and let that entity off the hook for that. Does the company still record as lessee for the remainder of the lease and as a lessor to the subleases? So I'm not sure if I know exactly what that's asking, but again, you would follow, to the extent that you're in a lease, you would follow that lease accounting guidance. And if you have a sublease, then you follow the lessor guidance. Most of the lessor guidance, they did make some incremental changes to it, and we didn't go through sort of a comparison. But most of that guide is still intact as a lessor. And again, unless you meet the definition of, a direct financing lease or a sales type lease, you're probably an operating lease, which means that you have a lease liability as the lessee for your obligation, and then you're just recording the sublease income as it comes in on a straight line basis. All right, and the next one. If we have an option to renew a lease at fair value at a future time, how do we value the right of use asset today? How do we recognize the true up in the future? Through the income statement or through retained earnings? Well, so when you book your right of use asset and your lease liability, again, it's based on what is the fixed payments as of today you schedule those out, present value them back, and then as you have market rate adjustments over time, unless there's a reason to remeasure, then you just book those incremental differences in the fair value as just current period income statement activities. So let's say that it's $1,000 a month for foreseeable future. Let's just keep the discounting out of it just for simplification purposes. So you enter it into a lease and it's $1,000 a month. And so we project that out, present value back, and then as we're having our expense, let's just say it's all straight lined and simple and there's not any other prepayments and those types of things. So your lease expense, and it's an operating lease, your lease expense is $1,000 a month. It will still come out to be that $1,000 a month. And then if in year 2, there's a market rate adjustment, or year 5, there's a market rate adjustment and it goes up, let's say by $25. So now it's $1,025 a month because it went up 1% or whatever it was, a couple percent. Then in that instance, that you're still amortizing lease liability and right use asset as if they were that initial $1,000, and you would not remeasure that unless there's a triggering event like Kristen covered. And that extra $25 just becomes an income statement activity where there's just more lease expense in that second year. Your lease expense is higher. So hopefully that made sense. But happy to talk again more offline if you want to do that. But again, that is sort of a confusing concept. Is we take the payments as they're fixed today, we book it as they're fixed today, and then as they get escalated with, they have different escalation clauses, fair market value adjustments, CPI index adjustments. Those just run through the period in which that impacts. So your lease expense will be more expensive in those years of those escalations, but you won't remeasure the liability or the right of use asset unless a triggering event occurs, as Kristen covered in those in those remeasurement considerations. And then there was one question that I think I went through them too quick before on rates, and I'll just talk about that real quick, and then I'll jump into this next piece. When we're talking about incremental borrowing rates, one of the questions came up is how often do we have to determine those rates? Is it daily, throughout the year? And I think judgment can be used in that. I think a lot of entities normally would just maybe refresh that a couple times a year, depending on how many leases you're getting into. If you only get into 3 or 4 leases a year, it's probably just whatever you're doing at that point in time, determining what that lease rate is. If you're getting it more continually, I think a lot of entities are looking to calculate that a few times a year, not more constantly than that. But you obviously need to be responsive to market adjustments and market changes. And if you end up in a situation like we're in sort of an unstable market or an uncertain market where we don't know what rates are going to do, and if there's big movement in rates, if you say, oh, we're going to calculate quarterly or semi-annually, that's probably reasonable most of the time in a stable market. But if there's a big escalation in that, that quarter since the last time you did it, probably need to refresh that. So, but again, judgment on that case. All right, I'm going to share my screen and let's see. All right, does that look like the main screen? I can't tell from here.
Yes, it looks good.
All right, perfect. All right, related party leases. So we've had a couple of different questions come up on related party leases. And so let's talk about that. The intent of the standard, was written such that related party leases should be recognized the same as, third-party leases. They use the same terminology throughout. And so that terminology is the lease legally enforceable? So what is the legal enforceability? And so from the FASB's perspective, they were expecting that, it doesn't matter whether it's a related party or not, you should get to the same conclusion. Now that becomes challenging when you get to month-to-month leases. And before we get into month-to-month leases, we've had a number of entities come forward and say, hey, we've got common ownership. I think I'm just going to switch everything to month-to-month. Well, before you change your contracts that way, make sure that you've talked with any investors or lenders or owners in addition to that, because there could be a challenge in there where if you have if the entity that holds the real estate has financed that real estate, the lender may want to know that you have a long-term agreement in place for the lease. So, or if there's an investor or somebody like that. So it may not be as simple as, well, I own both sides, I'm going to make that determination. It could be that there's a lender or somebody else that's, you need to evaluate the impact on them. So may not quite be so simple. But again, the main premise is, is it legally enforceable? So let's talk about that for a minute. As I mentioned earlier, I've had a couple of questions come up and I answered this a little bit earlier, but I'm going to expand a bit on it now. The FASB mostly writes from a public company perspective, and they do have the private company counsel that counsels with them and gives them private company considerations. We have a member of our National Assurance Office, Angie Hillestead, who's actually on the Technical Issues Committee for the ICPA, and they meet with the FASB regularly and talk about standards. And they actually reached out to her and were asking her some questions on, what do we do with these related party leases? What are the issues that are coming up? Because we hear this keep buzzing in the FASB arena, and so help us understand what the challenge is. And we sent them some case scenarios that I'll walk through with you. And then I've got a call next week where we're going to talk more about them. And then whether or not they respond to that in the form of some sort of application guidance is uncertain. But here's a couple of common scenarios that come up. The first one is, have a client, have an entity, they enter into a 20-year lease and they've got 2 5-year renewal options. Because they're a related party, is it expected that they will exercise all the renewal options? And as I had this conversation with a client of ours and I asked, well, can you project what your operational needs are going to be in 25 years? Because the company primarily functions off the operations and the cash flow from the operations. And so they're looking for, the real estate needs to meet the needs of the operations. And if that real estate isn't meeting those needs, they will move. Even though it's under common ownership, they need to be in the place where it's the best geography, location, meets the needs, meets the size, And so as we started to talk through some of those, economic factors, while the intention and the hope is that it continues to meet the need, because the common ownership did invest in the real estate. As we start to look out 25 years, management was like, I don't know that I get the 75% certainty. I mean, our hope and our intention is that it will, but when you start to talk about, will this continue to meet our needs and can we project what that's going to be in year 20, there's less certainty there. And so it may or may not be certain. And it could be that, yeah, we've built this out that we think it's going to meet it indefinitely. And so not that facts and circumstances couldn't change, not that it couldn't result in remeasurement at a later date. But yeah, we think we're going to be there for the full 30 years, which includes the initial 20 plus the 2 5 years. So it could go either way. But my point being is I wouldn't quite jump to the conclusion that that will exercise as renewals until you've gone through a similar exercise as you would with an unrelated party. The second sort of common scenario that's come up is, okay, we went month to month and we're in a month to month situation and there's either the agreement is month to month or there's no agreement at all, or there's no written agreement. And then we put $1 million in leasehold improvements. Do those now, technically what you'd look at that and say, well, if the renewal period, or if there is no contract for some multi-year period, then and you're only month to month, one could conclude that the $1 million that you spent on leasehold improvements should be expensed in the month that you expense them, because you're not locked into any long-term use of that. Remember, typically leasehold improvements are the lesser of, the useful life or the lease period. In this case, the lease period is a month, and so should you expense that? But the questions come up, okay, if we spent $1 million, we're month to month, or there's no contract at all, we spent $1 million on leasehold improvements, is there an unwritten or implied obligation that the lessee gets to remain in that until they've got their return on their investment of that leasehold improvement? And right now there's nothing in the guidance, but there's white papers that suggest that you should seek the advice of legal counsel to determine if you really do have a unwritten right to stay in that facility until you get your return on investment of that $1 million leasehold improvement. And if that's the case, is that an implied or an unwritten lease term contract? So again, no guidance on that, but those are the challenges that come up. And again, hopefully we'll get some application guidance, from the authoritative bodies, in the near future. But those are the situations that are challenging when you're in this. But the standard itself says, what's the legally enforceable term? And it doesn't matter whether it's related party or not, that is the lease period. So a couple challenges there on related party. So a couple more things we'll cover, and we're getting close to the finish line here. So a couple things to think about as you work with your lenders. As we've talked with lenders and worked with them, a lot of them are looking to either provide either a waiver for not meeting covenants, or they're looking to maybe amend to exclude leases from their covenants. But it's sort of all over the place. And I think a lot of them are waiting to see what's going to happen. But the challenge is the lenders have already developed their models, and they don't know in any given situation how much these leases are going to impact their covenants. And so a lot of them aren't ready to just provide like a change in the ratios. If you've got ratios in your covenants, they're not ready to just say, well, let's just change the ratios to meet sort of what your operational lease circumstances are, because it's just all over the place depending on how many leases you have and whether you own and all those other factors. And so a lot of them are either going to waive or amend depending on it, just to see what those ratios come out to be, because they just don't have a great benchmark for what the ratios need to be with that included. So my main point is go work with your lenders and be in advance with them on what you need to do for your circumstance. And again, don't wait on this lease. I mean, let's make sure over the summer, we got a little bit of summer left and early fall. Let's, take a, try to get to the calculation point so that we can go to lenders with some information. But in any case, the types of things that are going to be impacted, as you can see on here, current ratio, quick ratio, net worth calculations can be impacted. So those are some of the ones, debt to equity. Those are the types of calculations that are going to be impacted. The ones that should not be impacted are your EBITDA, your gross margin, your net worth. So anything that's, again, generally the expenses are expected to be sort of the same over the course of time. But the main thing is go talk with your lenders, go talk with your investors, whoever you have covenants with, and make sure you're on the same page with what that plan is. All right, we're in the last little piece here. We're going to cover, and we'll go through this fairly quickly. There's a lot of slides here, mostly because I wanted to give illustration, but I'm going to go over them sort of at a high level, then try to leave room for a couple of questions without going over our time here in the next 10 minutes. So overall, there's an increase from the current disclosures of 840. And the primary purpose of the disclosures are to help users assess the amount, timing, and uncertainty of cash flow that arise from leases. So there's some general information, and that general information, description of the leases, and I have a slide on that, and we'll go through it pretty quickly, but a lot of the general information we already have in 840. So a lot of that isn't going to change. We have this many leases, this sort of the range, we can group it together. If you look at the very last bullet I have on here, judgment on the level of aggregation and disaggregation, we have that today too, but this is where you'll have to determine, okay, what sort of leases do we have, where are they at, and what are the amounts, and then determine how much, is it just one lease line item in the disclosure? Are we going to break it out into classes? What's most relevant for the users? And there'll be judgment involved in that. But the first thing is to gather all their information, but then let's go through and determine at what level is it useful to the users. So we talked about the general information, again, description of the leases, the variable terms, any renewal option considerations, residual value guarantees, restrictive covenants. I normally don't see covenants on leases, although sometimes I do, particularly when there's a lender involved in a particular lease arrangement. They can have covenants that are similar to your debt covenants. Then any leases that in which, if there's any commitments. So we talked about this before. So if you entered into a lease arrangement, but you haven't recorded it yet because you entered it into it in December, again, December year end, you entered into it in December, it doesn't take effect until February, you didn't record it, but you have some obligations out there, you've disclosed that. Any significant participation in leasehold improvements, do you have any commitments out there that way? And then any significant judgments and assumptions that you've made, determine whether or not a contract is a lease, allocation between lease and non-lease components, discount rates. So again, more information. What's the total lessee's cost? And you can see all the different pieces here. So what is our cost? And I've got some illustrations about this too, so I'll sort of skip through this. And you've got hopefully the slide deck for your information. Information where we disaggregate financing and operating leases. And I'll give some illustration of this. This could be in the face and it could be in the notes. You know, when it comes to cash flow, is it on the cash flow statement or do we need to disclose it in the notes? A couple main ones that I want to point out here are, you know, this weighted average remaining lease term and this remaining average discount rate. Those are new requirements that are going to take some calculation. This is where if you have a software, most softwares will calculate that for you. If not, it's going to be a little bit more work on the part of the entity to determine what those are. And then other disclosures, related party lease, you know, related party transactions, any practical expedients that you've elected need to be specifically disclosed. And then anything else. And then just has other information. So I put in here, like if you're doing remeasurements, contract modifications, those things, you know, that's a judgment call for this other information, something that would be, if it's, you know, meaningful to those users. So let's go through some illustrations. So this is what it would look like on a balance sheet. This is an illustration recreated. Again, this level of information could be in the balance sheet or it could be in a disclosure, but you do need to disclose what is, you know, the total right of use assets by operating and financing leases, both the right of use and the lease liability. So again, you can put it in the face, you can put it in the disclosure, but it needs to be clear. Here's the same example, and this is in the expense section of your statement of operations. And then the next one here is what it would look like on a cash flow statement. You know, again, disclosing that information. And then this is just the same information, but it's just formatted where this would be a disclosure. So if we just had, you know, long-term liabilities was on our financial statement, then we'd need this level of disclosure broken out by current and long-term portions in our, you know, disclosure. So it could be in either one, doesn't need to be both, but to the extent that that's not, you know, to the extent that it's material and it's not otherwise segregated out, make sure it's in the disclosure. On these next two slides, I actually pulled these directly from the standard. So the standard says, hey, here's a way in which you might disclose this information. And so this slide and the next slide disclose information you need to get to what the total lease cost is. And then this slide again is all the other information. So gain or loss from leaseback transactions, the cash, you know, if it's not apparent from the cash flow statement, some of the cash flow implications. And then again, you can see down here, you know, weighted average lives and rates. Again, this is something that will need to be calculated. So this is new information. So a lot of the disclosure will be retained, but this is new information. And then Kristen already covered this also, but just I thought it was worth repeating. In the first year of adoption, if you only adopt for the current period and you present comparative financial statements, then all the 840 disclosures from the prior year are still required. So you might have two sections and it's long, several pages for the current year, several pages for the prior year, and the prior, including last year's payout schedule for the prior year. Often that payout schedule doesn't get rolled forward because it's only relevant for what's the future payout as of the end of the most current period. But in this case, you're required to retain the entire prior year disclosure as well as adding the new year disclosure. That was something that came up in sort of a public company study also of deficiencies, saying on that year of adoption, they didn't retain all the 840 disclosures. So making sure that you're getting all those. So with that, brings me to the end of the slide. I'm going to pull up, it looks like a few questions have come up, but I'm going to try and answer questions here in the next couple of minutes. Have you had any clients that often have a gap departure to avoid implementing the new lease standard? So the answer to that question is we have a number, well, it's not effective. Well, they're working on it now. So, but we have a number that are specifically evaluating that. One thing you could look at is if you, right now, you should have already adopted, you know, under 840 disclosure that shows what the total payout is. So you know what the total, you know, future payout, although it's undiscounted and those types of things, at least that gives you a starting point to determine, is this material to our financial statements or not? And that's something you need to talk with your auditors about. Also comes up, well, if my financial statements just get reviewed or I just have a compilation, this is an accounting standard. So it doesn't matter whether you're getting audited, reviewed, or compilation, or just a financial preparation. If you're saying it's in accordance with GAAP, then it doesn't matter what that level of service is. We do have a number of people saying, well, I'm just going to take a departure for this. You need to talk with the investors and lenders and the users of the financial statements, determine if they agree with that. But what I would say is, depending on the circumstances, a lot of standards come out that are challenging to begin with, but once you get into them, that becomes what we do. So I wouldn't default to, we're just going to GAAP departure this. I would encourage that as a starting point, but certainly we are expecting a number of entities that will probably make that option. We're implementing GASB 87 and 96 for both years. Can we put disclosures in the same section of the notes of financial statements? Or is it recommended they each have their own note? So again, this is a GASB question, not a FASB question. But to the extent that you're early adopting, the standing center bodies don't give that level of detail. So as long as it's distinct and clear, you could probably combine it. I haven't really given that a lot of thought, but I know the standard wouldn't be so prescriptive as to require them to be, where they'd be located. So as long as the requirements are met and it's clear, that's fine. So you'd need to make that determination based on the activity in both those areas. For related party leases, do we need to separately disclose on the face or the balance sheet related to non-finance leases? So for a related party lease, so the standard has, I'll say 3 parts, and this is coming 2 standards together to some degree, which is related party disclosures as well as the leasing standard. So the leasing standard requires that you disclose financing and operating separately. And then there's also required to disclose related party leases. And so how you do that is, there's probably some flexibility, whether that's in its own related party note that sort of carves that out, or if you want to somehow have subgroups within there and say related to non-related parties. I know, like in some of my clients where most of the real estate is owned by a related party, we tend to actually break that out within the lease disclosure today under 840. We break out and say, hey, here's a related party component, here's a non-related party component. So if it's pretty involved, that might be the most efficient way to present that information. But the standard is just this: operating and financing need to be disclosed separately, and then you need relevant disclosure related to about related party transactions. So how you decide is the best presentation probably has some flexibility between those. But I think generally, if you had within operating and financing, if you had them split out between related party and non-related party, that might be a clean presentation opportunity. But again, the information is required, but how you present it is flexible. So, all right, any other questions we have? I'm down to the last minute, but I think I've answered every question that's come through.
I don't see anything else, so I think we are good to go. Hope everyone has a great rest of their day and a great weekend. Thank you so much for attending. Thank you, Scott. Thank you, Kristen. And we'll talk to you guys next time.